$20,000 gold. What happens if gold actually goes there? This is not the first time you're hearing that prediction. Last week, Andy Scheckman told me gold could get revalued to $20,000. But what actually happens? What does the world look like? Well, who better to answer that question than Peter Schiff? And Peter, we'll talk about that here in a second, but we also need to talk about why my gold and silver stocks are crashing while gold is at an all-time high. I want to know what you're doing with your stocks. Maybe your stocks are not crashing. I want to know what you're buying and what you're selling, as well as I want to know what you think or why you think the Fed needs to hike rates here instead of cut them. So plenty to go to, especially considering that after I let you go, which is going to be in about what I hope is going to be 90 minutes or something along those lines, I also have two companies to grill on the CEO barbecue, with that being Arras Minerals. They're looking for gold and copper in a jurisdiction that most of us didn't even know had any gold and copper up until a few months ago. And then I'll be back to the Timmins Gold Camp in Ontario, Canada, where I'm going to be looking for large gold deposits with GFG resources. So again, plenty to go through on this episode of Real Money Talks. And Peter, you've been on the channel before, so we can maybe ignore the introduction, but we cannot ignore, again, this all-time high in gold, steadily and strongly above $2,500, one of the best performing metals on a year-on-year basis. So naturally, everyone's bullish and we have no issues, or at least that's what a perfect world would look like. But in this world, we do have issues. We have people, there is a lot of people who are not trusting this bull run and are saying that gold is overstretched here. They're looking at the gold stocks, they're not moving as much as they would like to, and they're saying gold's going to come crashing down. But the most recent episode of your live show is called Gold Breaks 2,500. Kamala would send it to the moon. So I suppose a multi-folded question here, but where's the moon and why would Kamala send it there?
Well, it's just, the moon is what everybody in crypto says. So just kind of poking fun at the Bitcoin crowd, talking about something going to the moon. But obviously, it just means it's going to go way up. Literally nothing's going to go that high. But it's going to go a lot higher. And it's actually going to go a lot higher regardless of who wins the election. I think that the potential is probably even higher if Kamala wins. But, we've now closed 3 days in a row above 2,500. We set a new record high intraday today. I think we got above 2530 before we got a little profit taking in the futures traders. But we still closed at a new closing high on the day, very bullish. But, the gold stocks, many of the big ones made new 52-week highs. But most of the stocks, lost a lot of their gain simply because gold didn't close on the highs. When gold pulled back, a lot of the gold stocks lost all their gains because the gold stock traders just don't trust the rally. They haven't trusted it all the way up. I mean, the whole move from 2,000 to 2,500, the gold stock traders have just really been against the move. They've been waiting for a shoe to drop and gold to crash. And so they reluctantly buy the stocks because the metal keeps going up. But there's not a lot of conviction there. There's not a lot of enthusiasm there. And I think that's typical in the early stages of a bull market. Gold has gone nowhere for so long now. It was gone sideways for over a decade that people have, given up on it. And people are very skeptical of the move. And I think that's very bullish because it really is another indication to me that we're going up, right? Because there's not a lot of people that are in the trade yet. And they will go eventually. I mean, people forget that before gold went sideways for a decade, it went from under 300 in 2001. I think we started this a century. Gold was about 270. And during the first decade, it went from 270 to 1900 by 2011. That is an enormous move. And so from 2011 till just this year, really, all we did is go sideways between 1900 and 1600 after gold initially pulled back to 1050 in 2015. Then it rallied back and it kind of just built a base. And what we've done now in 2025 is we've now started a new bull from that base. And it's not an accident that the rally is starting just as the Fed is preparing to enter the next easing cycle, right? I mean, I think they've been easing for a while because they stopped hiking, and they already tapered back the size of their QT program. So that's already an easing that they've had. But they're about to cut rates in September. And I think by the end of the year, early next year, they'll be back at QE again. And so the gold market is already sensing this, and it's starting to move up. And the dollar, it's not a coincidence that the dollar index hit a new low for the last 7 months. So it's back to the January lows, and we're about to take that out. So you're seeing a weak dollar, you're seeing strong gold, all indicators that the Fed is, too easy and about to make a policy mistake yet again by cutting rates. I mean, not only should they not cut rates, they should raise them. Of course, the markets would react horribly to that. Stocks would tank. It would be horrible for the economy, but that has to happen because the economy is a big bubble, and artificially low interest rates are a big part of the problem. And so normalizing rates are part of the cure, but it's not a painless cure. And so that's why the politicians and the central bankers resist it and just try to come up with gimmicks to kick the can down the road so they can postpone the day of reckoning. And so most people, though, don't even know what's going on with gold. Even the financial media barely talks about it. They don't notice it. They still spend a lot more time talking about Bitcoin than gold, even though Bitcoin has lost more than 30% of its value priced in gold over the last 3 years. So this is a major bear market in Bitcoin, and you wouldn't know about that from all the media and all the hype. Bitcoin is supposed to be digital gold. Well, it's been underperforming digital gold for the last few years, and it's going to get worse over the next few years as gold continues to go higher and Bitcoin goes much lower. But so it's not just that traders don't believe in the rally. They don't even know what's going on. They lost interest in gold years ago. And so it's going to take a much bigger move to, I think, rekindle that interest. So maybe when gold's above 3,000, 4,000, I don't know where the tipping point is where, it excites investors. I mean, they typically look at past performance and then chase it. So when gold has really, really good, 1 year, 3 year, 5 year type of returns, people might really start to look at it. And especially if you start to see, some faltering in the NASDAQ, crypto, what was working in the past, if that stops working and gold is working, then a lot of the people who follow that momentum might start moving money to gold. And that will ignite the next leg of the bull market where you do get the excitement and the enthusiasm that we don't have now. And that is going to be a much bigger move. At the end of the bull market, whenever that comes, that's when you get the euphoria, right? That's when you get the last doubters throwing in the towel and, FOMOing into the market at the top. I mean, we're not anywhere near the naysayers capitulating on gold. And, the gold stocks, of course, it's going to happen there. You're going to see a lot of people in gold stocks. I was at a party the other day with the CEO of Bitcoin Magazine, and they just, he just had this conference in Tennessee, and they had like 22,000 people at his Bitcoin conference. And I go to gold conferences. I mean, the one I mainly go to, the biggest one that's been around the longest is the New Orleans conference, which is once a year. I'll be there this November. They get about 500 people coming to this conference. When gold has a conference where 20,000 people show up, maybe we'll be near the top. But right now, this is a bull market that is completely under everybody's radar. But, the fundamentals have never been better for gold. The technicals have never been better for gold. So gold's got only one way to go. And, despite all that, you still can't give away these mining stocks, even though, we had Newmont, Barrick, Agnico Eagle, Alamos, IM Gold, a few of these stocks have hit 52-week highs. Most stocks have not hit new highs. And we're just talking about 52-week highs. These stocks are nowhere near their all-time highs. Most of these big stocks hit their all-time highs in 2011, right? And gold peaked out at 1900. Now, of course, what's happened over the last 13 years is the cost of mining gold has gone up dramatically. So the gold mining companies aren't even making as much money at $2,500 gold as they did back then at $1,900 gold, except that $1,900 gold didn't last very long, right? We had a big drop. But I think you're about to see a boom in earnings from the mining sector over the next several years. I mean, you're going to have huge beats. They're going to be increasing their dividends because finally, I think the price of gold is going to go up faster than the cost of mining it. I mean, gold stocks have been the ironic victims of inflation because inflation has been so pervasive yet so, under noticed, or that even though there's been all this inflation, investors haven't felt the need to hedge inflation. And so inflation has caused the cost of mining to go way up without a commensurate rise in the price of gold. Now, gold's about to catch up. And so I think you're going to see the price of gold moving up much faster than other commodities. And that's going to be a big boom for the gold mining sector. Now, normally, right, if all of a sudden gold were to shoot up and the gold miners are making all these profits, other businesses would try to, come in and they raise capacity or do something to compete for those, excess profits. But it's not going to happen. I mean, it takes a long time to bring a mine into production that hasn't been in production. In the meantime, nobody's been exploring for gold. It's been minimal. There haven't been any major discoveries in the last 10, 20 years that I know of. And so there's no ability for the market to really add to the supply of gold if there's a huge increase in the demand for gold. And so the mining companies that are there, they're just going to have these huge profits for many, many years to come because of what I think is going to be in gold. That's why I'm so heavily invested in the mining stocks. Of course, I've been there for a long time, and it's kind of been dead money. I mean, you look at where those stocks are, I could have made so much money, more money if I was in tech, if I was in the Mag 7. But I think at the end of the day, I'll end up making more money than those people. It's just, it's like the slow and steady wins the race. I think I'm gonna end up with all the chips at the end of the game, right? Even if I have the short stack now, eventually I'm gonna be the chip leader.
There have been major. I want to talk to you, Peter, about the gold stocks. Maybe later on in what you're doing with your portfolio. There have been a couple of major discoveries. There's some stuff that I'm watching. Red tape is growing, though. Community issues are becoming more challenging to put these things into production. What I do want to talk to you about before that, though, is something that I've been wondering about myself because I have more exposure to gold stocks than I do physical gold. And that's why I'm thinking.
Same with me.
But I'm thinking, what about a broad liquidity event, though, in that case, where everything that has a bid on it gets sold? Like what happened 2 Mondays ago with the Japan carry trade, gold got sold down, gold stocks, GDXJ, GDX, whatever, all of it was down.
Yeah, well, as long as you don't have, margin debt against your gold positions where you may be forced to sell into that type of liquidity event, it doesn't matter to me if the market price of my stocks that I'm not selling temporarily goes down. I mean, if I have more money, I'll take advantage and I'll buy some more, but it doesn't affect me if I know the stocks are just going to bounce right back once that emergency selling is over. So I'm not so concerned about that because, when I own a gold mining stock, and you said, you don't have a lot of physical gold, you actually do. When you own a mining stock, you are a part owner of all that physical gold that is in the ground that can be brought out of the ground and sold. And we're buying the gold for a fraction of the actual market price of that gold because it's still in the ground. But you own that. You have the right to mine it, and you have the right to sell it. And so as long as I know that the price of gold is going to go way up, it doesn't matter so much in the short run if these gold stocks drop. Yes, maybe I could have bought more cheaper if I had just waited for that to happen. But what if it doesn't happen? What if the stocks just go straight up? And I'm just out of luck. So I'm willing to accept the volatility that may make the stocks go down because I'm confident where they're going to be in the end. Now, of course, other things could happen that's more important. Governments can nationalize mines. There could be a big accident. A mine could cave in. Miners can die. They file a lawsuit. I mean, there's all kinds of things. Gold mining is a risky business. It's not an easy business to get in. And again, that's why you're diversified. That's why, I encourage people to buy into my mutual fund, the Euro Pacific Gold Fund that's managed by Adrian Day. I think he does a great job of building and managing a portfolio of mining stocks where he's following everything that's going on. He knows the management teams, he knows the projects, and he can separate the frauds, the landmines from the true gold mines. So yeah, because you have to be diversified. And I think he's forgotten more about mining stocks than most managers know. He's been doing this thing for 40 some odd years. Most people, they're not, all the smart analysts, they're in tech, they're in pharmaceutical, they're in some of the hotter areas. I mean, no one's in mining. I mean, it's been a ghost town. There's hardly any banking deals. The analysts want to go where the banking deals are. Gold mining companies haven't been able to raise any money. Nobody will give them any money because nobody cares. But that's going to change. It's going to become a lot more popular. And so, people can buy my gold fund. There's actually a no-load version, EPIGX, the Euro Pacific. It's the advisors gold. You can buy it at any discount brokerage firm there is. And you could also contact my advisors at Euro Pacific Asset Management, and we'll get you into the fund. We actually also have separately managed accounts, so you can have your own brokerage account if you don't want to be in a fund, and we'll manage it for you. Adrian manages those.
With the Euro Pacific, you have other funds too, by the way. With Euro Pacific Asset Management, different funds like there's the International Value Fund, Emerging Markets Fund, there's the International Bond Fund. None of them have performed well over the last decade, and I suppose that relates to to your overall picture of the economic stance here. What do you think that is, and are you doing something different with this gold fund?
Yeah, well, we're doing. Yeah, look, we're like my value fund as of yesterday was #1 in its category year to date. Out of 345 funds, it was #1. But 3 months ago, it was in the bottom 10%. Now it's or the top 1%. I don't know if I'm #1, #2, #3, but I'm in the top 1%. And over the last 1, 3, and 5 years, I'm certainly in the top 10%. I mean, at one point, at the end of last year, I was in the top 1% for 1 year, 3 years. So, we were underperforming, but all that has changed recently because we're focusing on certain types of stocks that have been out of favor that I believe are now just coming into favor. And so I expect that by the end of next year, my value fund and my dividend payer fund will be #1 in their category for the last year, 3 years, 5 years, and 10 years. I mean, my only track record on those funds that's not good is my 10-year track record, because we had a big drop in 2014 and 2015 as the dollar went way up and gold went way down. But if the current trends continue until the end of next year, I mean, no one will be able to touch me, because nobody has the type of stocks, because everybody is too afraid to veer too much from the benchmark. So if the benchmark says, 20% financials, maybe you'll be 19% or 21%. Nobody wants to be too far. I'm like 2%. I don't care. Like I'm just going to buy what I think is good, and I don't care about the benchmark. And I'm willing to underperform for a few years if that's what I need to do to outperform. Like my bond fund now. I have a bond fund I was like in last place. I had 1 star until last year. And at the end, at the end of 2023, I had like 1 star. I was like in last place. I was in the bottom, 5%. And I was #1 fund last year, #1 bond fund. And then all of a sudden my fund has 4 stars. And, year to date, it's given back some of the gains. But I think over the balance of the year next year, I'm going to kill everybody because of the type of bonds that I own and the type of currencies that I bought. But one of the reasons that I underperformed for so many years is because I knew the bonds were a bubble, and so I kept my maturities short. And so I was missing out on the gains. But then when bonds got brutalized, for a couple of years, my funds were unchanged or slightly higher. So I made up all that underperformance very quickly. So I think my strategy, the strategy is value, dividends, and I'm trying to buy companies that will benefit from the emerging market consumer that I think is going to see a big increase in their standard of living and their purchasing power as the dollar, really takes a big dump, which I believe is going to happen. The dollar index, I said now it's about 101.5. I think when it cracks, through 199, I think it's going to go to 90 pretty quickly. It could even do that before the end of the year. We'll see. But I think once it trades below there, I think in 1 year it can get down to 70. And that's around the all-time record low for the dollar index. And if we take that out, it could drop to 50, 40. I mean, just get a decimated. And, in that environment, gold's, 5,000, 10,000, maybe more. Because it's not happening in a vacuum. And at some point, the bond market's going to come under enormous pressure. And the Fed is going to have to do massive QE. I mean, not going to have to, but they're gonna, because the alternative would be, too much to bear. So they're just going to crank up the presses even more, which of course is just going to fuel the fire in gold, sending it much higher, sending the dollar much lower. It's, then, inflation is going to run rampant. And what are they going to do? Price controls, right? They already told us that's where they're going. That's how they're going to try to, put a Band-Aid on this cancer, is they're going to try to stop people from raising prices. But
So
that's just going to stop people from buying goods because they're not going to be available.
I do want to talk about that later on, definitely about and then potentially doing a rate hike on the back of that. But Peter, what I'm thinking about here, just to go back to the gold stocks that we're talking about, you say I don't have an issue with them falling because I can buy more. My issue with that in my portfolio is that I'm exposing myself to significant dilution risk, right? Because oftentimes these things that I'm in, they're non-revenue generating companies. They have to go back to the market to keep raising cash and so on and so forth. How do you manage that? What kind of companies are you in right now to help you manage that risk?
Well, those are the smaller ones. I mean, the bigger companies have plenty of cash and they have plenty of earnings because they're selling gold. But the smaller companies that are in earlier stages that are building out mines, and they've been diluted quite a bit over the years because they've had to issue a lot of stock at not such great prices because we've been in this long bear market. But that's one of the reasons that there's been so little developed in mining. And I think what's ultimately going to happen as the price of gold really moves up, and the Barracks and the Newmonts, when they want to increase their reserves, they're just going to buy those reserves on the stock market. They're not going to invest in exploring for gold. They're going to go to the smaller companies that they know have gold, and they're going to buy them out with their appreciated stock. And so you're going to see further consolidation in the industry, as a lot of these companies that just don't have a lot of capital, but have a lot of undeveloped resources, they're just going to get bought up. And that's why we own a lot of those smaller stocks in my gold fund, anticipating that is ultimately going to happen, within the sector. But right now, I mean, the big balance sheets, the big companies have great balance sheets. They got plenty of cash flow now. A lot of them have been paying down their debt too, with a lot of the earnings that they've had, with the gold price. So I think the industry is in good shape. It's had to weather a very long-term, bear market, and so they've gotten efficient. So all this increase now that we're seeing in gold price is just going to drop to the bottom line, but it's going to be more than that. I mean, because let's say, gold's going to hit 3,000, 4,000, 5,000, I think, before too long. And what that's going to do is it's going to unlock a lot of value that is not represented in the stock price at all right now, because a lot of these companies have reserves that are high cost. And let's say I'm a big mining company and I have a huge deposit of gold, but it's going to cost me $3,000 an ounce to get it out of the ground. Well, that's worthless as far as Wall Street's concerned. because gold's only 2,500, so it's you'd lose money on every ounce, right? So that's not a good business model, even if you can't make it up on volume, right? But if gold goes to $10,000, even $5,000, and even the cost of mining it goes from 3,000 to 4,000, all right, well, you still have a 25% margin on extracting that gold. You have a lot of it that really adds up. But I think the price is going to go up dramatically. I used to think that gold was going to go to 5,000, back in 2008, 9, 10, 11, based on what I saw with QE and stuff. It never made it. I mean, it just barely made it to 2,000. But given all the money that's been printed since then, I mean, 5,000 is just, I mean, my target is so much higher than that. I mean,
What's your
it's more
target?
likely to be 10 or 20,000, maybe more.
More.
Because it just has to, find an equilibrium with all the new money. I mean, all the euros that have been created, and the yen and the dollars that didn't exist 10, 12 years ago. Think about the global money supply compared to the global gold supply, right? The money supply has gone through the roof, and the supply of gold has not. But it's not just the current money supply, but you have to think about what's going to happen to money supply over the next few years as central banks have to crank up the presses to prevent interest rates from rising, long-term interest rates, as they start buying. And a lot of these governments, like right now in the U.S., the national debt is 35.2 trillion. And we're spending about 25% of our tax revenue on interest on the debt, which is now the third biggest government expense. It passed, this year it passed defense. So you got Medicare, Social Security, interest on the debt. But by the end of next year, interest on the debt will be bigger than Social Security. And by the end of the following year, it'll probably be bigger than Medicare. And it's going to keep on growing. And eventually, interest on the debt will consume 100% of all the government's tax revenue, which means all the money the government spends on everything else is going to have to be borrowed. Well, obviously, nobody's going to lend somebody money if they have no capacity to repay it, because all of their income is already committed to servicing the debt they already have. And so, you get to the Federal Reserve becomes the only lender to the U.S. government. And the money supply just explodes, and it's just massive inflation. So when you look forward to how much money is going to be printed, and then you try to discount that into the price of gold, well, what should gold be in that world? And it's way, way higher than it is right now.
I recently spoke with Andy Sheckman, who was talking about the revaluation of gold, which he said could push gold to $20,000 overnight. And I'm just not. I suppose I have a hard time understanding how realistic that really is. So what are you saying? You're saying 20,000 is realistic as well?
Well, it's very realistic. I mean, first of all, gold is up over 8-fold over the past 23 years, right? 8 times. The Dow Jones is up 4 times over the same time period. So gold has dramatically outperformed the Dow over that time period. But even if you just take 8-fold again, right now we're at 2,500. So 8-fold is 20,000, right? But I don't think it's going to take 20 years to do it. And remember, it only took gold 10 years to go from 270 to 1,900, right? So a move like that, you're pretty close. But another way of looking at it is look at gold in relation to the Dow. Because if you look at the historic pricing of the Dow Jones, the bottom of bear market cycles in terms of real money, inflationary cycles, has been around 1 to 1, or maybe not quite 1, but 2 ounces to 1 ounce, where the Dow Jones is worth close to 1 ounce of gold. That's where it bottomed out in 1932, and that's where it bottomed out in around 1980, right? The Dow got close to 1 to 1. Yeah, well, because in 1980, gold got to 800 and the Dow got to about 800. That was, that's where it was. Yeah. And so they're about 1 to 1. And so if you assume that we're going to get into an economic situation where you see the Dow Jones and an ounce of gold at roughly the same price, which, occurred twice in the 20th century, so it may happen in the 21st century. Well, the Dow is 40,000. So how is that going to happen? How could they be the same price? Well, gold could go up to 40,000, they'd be the same price. Or Dow can come down to 20,000 and gold can go up to 20,000, they'd be the same price. Or the Dow could go down to 10,000, right? Or they could meet where the Dow goes to 50,000 and gold goes to 50,000. They could all go up, right? But as long as they get to about the same price. Now, my target is not really 1-to-1, 2-to-1 maybe, somewhere between 2-to-1 and 1-to-1. I doubt it'll maybe get exactly at 1-to-1. But even if it was 2-to-1, if the Dow stayed at 40,000, gold would have to be at 20,000 for the Dow to be worth 2 ounces of gold. So right now it's around 16. That's historically high. I mean, it's not a record. We got up to like 40-to-1 in 2001, like at the peak of the dot-com. That was the record. That was the highest the stock market has ever been. But if you go back to 1929, that peak, the Dow was worth about 20 ounces of gold before the crash. And it went from 20 ounces of gold to 1 ounce of gold. So we're not that much lower than 20. I think we're about 16. So we're closer to the peak of the 1929 bubble than the bottom of the Depression trough, 1932. So, there's a long way to go in where gold's ultimately going to go.
What happens to silver in that situation, though, because of his kind of duality, if you will, where it's an industrial metal now increasingly more so, but it's also a precious metal at the same time. But typically it outperforms gold during bull markets. Where do you see that going?
Yeah, I mean, gold is also an industrial metal, but to a lesser extent than silver, because gold is used in industry. But it's too expensive. So a lot of industries that would use gold don't pay the money because they don't need to do that. They can substitute silver for gold or copper or some other metal that doesn't do the job as good, but is more cost effective. But for certain things where you absolutely need gold, they buy gold. But yeah, I mean, there hasn't been a bull market where silver hasn't outperformed. So maybe this time is different. I don't know. But it's more likely that it's the same. And so I'm more bullish on silver, but I've got both. And I have more, more of my exposure is to gold than silver. But I do think that, my silver stocks could be my biggest gainers, relative to my gold stocks. But of course, all the gold stocks have some silver, right? I mean, it's hard to mine gold and not get some silver. But there are some companies that are, pretty much exclusively or mostly, because even the silver companies mine some gold, right? I mean, you're going to find it in the mines. They're generally there together.
What do you do for silver stocks specifically, though? Not many of those. There's not. I don't think there's any longer a pure silver producer to the degree that it used to be. There's a couple of silver undeveloped assets, but they're in Mexico. Mexico's challenging right now. What are you doing for silver exposure?
I said we have silver companies in the Euro Pacific Gold Fund, and I own positions in some of these stocks. Silver Wheaton, Pan American Silver. I own some of the smaller ones. Fortuna, Endeavor. I got a bunch of these names in my personal portfolio. But yeah, I mean, I own them, and I own silver the metal. I mean, we sell a lot of silver at Schiff Gold. I mean, the name is Schiff Gold, but we also sell silver. Just Schiff Gold and silver was a little long, so we just went with Schiff Gold. But yeah, I mean, and in fact, what the demand really is going to come in if we ever get something as asinine, and we probably will, as price controls. What happens when governments make it illegal for businesses to charge above a certain price? What happens is there's a lot of goods that are just no longer available. Either the company just went out of business, or it's in business, but it's only selling the things that are, it can sell profitably with the government's price limit. And so a lot of products are no longer available legally. But that doesn't mean that you can't get them, right? You just have to be willing to break the law and buy them on a black market. Now, the people who are selling you these goods on the black market are obviously violating the price laws, right? They're gouging you, right? They're overcharging you. And so they could be subjecting themselves to long prison sentences if they get caught, right? So obviously the risk of going to jail is going to be factored into the price they're charging you. So the stuff on the black market is probably going to be pretty expensive. But they're not going to take credit cards. That's for sure. I think what they are most going to want is silver, right? It's easily negotiable. You pay somebody with a silver dime or maybe a 1 ounce silver round, you can get the food items that are not available legally. And so there could be a lot of demand for physical silver as you have an underground economy conducting commerce in contraband, in illegal goods, because it's being sold at above the legal price limit. But that's the only way you're going to get stuff. Right? You might need gas. There could be long lines at a gas station because of price controls. So do you want to wait in line all day and get, a few gallons, or you want to buy some on the black market, right? And then, again, having silver to pay for it. So I think you're going to see that kind of demand coming in for silver, more so than gold, because it's easier. Where gold will work well is backing up a digital currency, tokenizing gold. Then you can engage in commerce there. But if you're using the internet, the government might be able to track what you're doing, right? So I don't know that the black market guy is going to want you paying him online through some way where the government knows, hey, this guy just gave you all this money. Why, what did you do for him, right? So you want to transact anonymously, and so physical precious metals will probably be the money of choice for the underground economy.
I like how you mentioned Fortuna when you were referring to smaller silver companies, because to me, smaller is typically 5 to 10 million, which is where I'm active in. And now that I'm saying it out loud, maybe my wife is right to call me a gambler. I like believing myself.
I forget. I threw some money into a private placement for a silver company that, they just got listed. I'm waiting to get my stock, but I invested in them last year. I mean, I've thrown money into some of these smaller companies. Just like you would put, a chips on a roulette wheel, right? But I try to be a little smart about the wager, and look at the risk reward to do that,
Yeah.
But like that stock that I bought, my gold fund bought it too, right? So if you own my gold fund, you're getting in on these deals. Like we get in on the good deals, the deals that Adrian vets. In fact, the only reason I bought is I ran it through Adrian, right? So I want to make sure that he likes it before I buy, because I see a lot of these deals, and most of them I don't invest in because I think it's too risky.
Yeah.
But the ones that are good, we buy them in the fund.
What deal was that?
I don't even remember the name of the company.
I should have asked Adrian. I saw him in Florida earlier this summer. He goes to these conferences too, right? He does the due diligence and whatnot.
I just know that it recently listed. I forget because I was told I was going to get my stock, and of course I got warrants too. So I got to, I get those.
Right. What about? Let's maybe talk about what you mentioned there at the beginning, where you said that you think, and I'm kind of under the impression that you believe that even now over 5% rates are too low, and you think that the Fed should be raising rates here. So pushing the real rate higher, essentially, wouldn't that be negative for gold?
Yeah, I think it would be if the Fed hiked rates in September instead of cutting them. I think gold would tank, but they're not going to do that. But gold would go down less than the stock market. So in that respect, you'd be able to buy more stocks with your gold. So if, your gold is your liquidity, and the Fed hikes rates and the stock market crashes by 10% and your gold crashes by 3%, you're ahead of the game in that respect. But, the Fed's not going to do that for the specific reason that it would cause a crash. And if the Fed hiked rates and it caused a crash, then they would cut rates. they would have to rescue the market from what they just did. And so then gold would go soaring to new highs before the stock market made new highs. That's what happened in 2008. When the market crashed initially, gold went from 1,000 to 700, but the stock market went down much more than that, percentage terms, like 40% or more. But then gold shot up to 1,900. It got almost double its previous high, long before the Dow even got close to its high. So that's what I would think. I mean, they don't have the guts to do what they need to do and just allow the chips to fall where they may and just tell the public, yeah, you got to suck it up and deal with it. This is the consequence of, 12, 13 years of 0% interest rates. We screwed up. We never should have lowered rates to zero. We never should have left them there that long. We got you all hooked on, a drug of cheap money. And now we got to get rid of that drug or we're going to have hyperinflation. And so you're going to go through the pain of having to live without this drug. Meanwhile, you've built an entire economy based on having this drug continuously, available to you. It's not there anymore. But so I think we're way past the point of doing the right thing. They're going to do the wrong thing. I mean, that's, people say don't bet against the Fed. I'm not. I'm betting that they're going to do in the future exactly what they've done in the past, and that is make the exact same mistake over again. And they're going to try to solve a problem that was created by artificially low interest rates with more artificially low interest rates. They're going to try to solve a problem that was created by excess money printing by printing even more money, because that's all they know. That's the only thing they can do. And so they're going to do it. And it's just that the next time they do it, it's like they're going to overdose on the stimulus. And that's why I think, gold's going to, just explode. And the dollar is going to implode.
Looking at what happened in the 70s, though, the Fed raised rates from about 5% to 8% in response to the oil crisis back then. Gold initially actually surged on that, and it came up to about $200 an ounce by 1974, but then it dropped to $103, so losing about 50% by 1976, right? Because those rate hikes apparently worked at the time. They stabilized the economy and prices. And are you seeing kind of a similar path here, or will this be more of like what happened to gold in Greenspan?
I think we already had that big pullback when gold went from 1900 to 1050. And so I think we've kind of had a big drop. So I think now we're going to have a big move up. Where we're going to have the next 40 or 50% drop, it's hard to say. Could gold go to 10,000 and then go back down to 5,000? Maybe. A lot of it is going to depend on what the central banks are doing at the time. But as of right now, gold is in a massive bull market, early stages. It's moving up in a very slow, orderly manner. There is no like euphoric gains. There's no huge price spikes. I mean, the biggest moves are to the downside. And if you want to see days where gold moves more than $50 in one day, much more of those moves are going down, not going up. And that's how bull markets work, because people are so afraid the minute the market starts going down, they think it says it's going to crash. Let me get out. And so there's nothing about this gold market that would suggest there's any kind of significant correction on the horizon. That's why I tell our customers at Schiff Gold, because a lot of people, when gold got to 2,000, they didn't want to buy. They thought, oh, this is the high. And I was telling guys, keep telling people, no, there's hardly any downside in gold. And I still think there's hardly any downside. Could you buy gold today at 25, 20, wherever it is? Can it go down to 2,400, maybe 2,350? Maybe. It may not, but it could. But so what? That's nothing compared to where it's going, right? The upside potential dwarfs the downside risk. The problem is the people that were waiting for 1,800, they didn't want to buy 2,000. Now they're probably waiting for 2,200. They may never get that. They should have just bought it at 2,000. And not worried about it. Now, eventually, people are going to, I got to get in. But most people, again, if they've been following this market, they expect it to come down, because they haven't been in a bull market. We've been in this consolidation of a bear market, for so long. And look at the ETFs. That's a perfect example. And I'm not sure if this has changed in the last month or two, but I know by mid-year, right? And this is one of the best years ever for gold, right? How much it's up, right? Gold ETFs had net withdrawals, liquidation, something that's unprecedented since, like GLD was formed. Normally, what happens is the price of gold goes up and that attracts money. The investor sees that gold went up and they buy. Then the price of gold goes down and they want to get out. Oh, I'm losing money, gold's going down, they sell, right? What's happened this time is as gold's been going up, the retail public has been selling the whole way up. I mean,
Hmm.
it's not that, why? These guys are suddenly better traders and they're selling into the rally. No, there's just no enthusiasm. They don't believe it. They're like, oh my God, gold's up. Let me take advantage of that. Let me get out. Right?
Hmm.
I'm going to do something else with my money. Now, some of that money went into Bitcoin ETFs, which was probably the dumbest thing they could have done with it. But some of it probably went into the NASDAQ or stuff that was hot. But the public is on the wrong side of this trade.
Hmm.
And you might think, well, if the public, the retail public, was selling gold, and they are. I mean, sales at Schiff Gold are down this year. I mean, everybody's are down. I mean, we might be down a little bit less. The wholesalers are telling us that we're, gaining our market share. But we're not selling historically a lot of gold right now. It's not like the phones are ringing off the hook. They're down everywhere, just like we had net with redemptions out of the ETFs. But how is it that the public's been selling, but the price of gold keeps going up anyway? That means somebody is buying to make that happen, to absorb all that selling and then push the price higher. And the buyers are central banks, especially the emerging market central banks. So who's smarter, the central bankers or mom and pop retail investors, who are buying ETFs, through, their Schwab account or on the Robinhood app? I think the central bankers, if they're buying gold, it's not like they can't. It's not that they can read the writing on the wall. They wrote the writing on the wall. That's why they know what's there. They know what's coming, right? They're at ground zero, and they're buying gold. But also, you've been seeing, the Indians buy gold, the Chinese buy gold. So I think they're smarter than the Americans and maybe some of the Western Europeans who have been selling it.
Hmm. How much of your thesis about gold is based on what you call the death blow to the US dollar, Peter? Like, how important do you think it is for the dollar to be crashing or going away for gold to go to these heights that you're talking about?
Well, I mean, the dollar is relatively strong on a relative basis, right? Not on a purchasing power basis. It's been getting clobbered. That's why prices are up so much. But the same thing's been happening in Europe and Japan. And so, because all the central bankers, that's why, when Biden tried to say, hey, inflation is not my fault because they have inflation in Europe too. Yes, because the Europeans did the same mistakes as the Americans, right? Their central bank did the same foolish thing as our central bank. Their governments ran big deficits and their central banks monetized it. So everybody's got inflation because everybody caused inflation. But when the dollar really starts to fall, which it hasn't done on a relative basis, only on an absolute basis. But when the dollar starts to lose value against the euro, which is starting, and it's been especially weak against the Swiss franc, and it's now weakening finally against the yen, it was very strong against the yen, and now it's weakening. But that is going to accelerate the rally of gold. And as the dollar really starts to fall, that's going to accelerate the rush to get out of the dollar. The U.S. benefits dramatically from the monetary system that currently exists, where the dollar is the primary reserve asset, and we could create them for nothing and use them to pay for $1 trillion a year trade deficit, which we absolutely depend on. And so we send the world the dollars that we create at no cost, and in exchange, they send us all these goods that we need that are expensive to produce, and we don't have to produce them. We don't have to use our labor, any of our resources. We just get the stuff because we, conjure numbers, on a computer. But when the world decides that they don't want to do that anymore, that they don't want to stockpile dollars, that they'd rather stockpile gold and hold gold as a reserve instead of dollars, which they use to buy U.S. treasuries, which are going to get decimated with inflation, then that's it. The party's over in America, because now we can't run $1 trillion a year trade deficit. But our economy depends on all those goods coming in. We can't produce the goods. We don't have the factories, the supply chains, the trained workers. So and if we had to pay for it, with what? We don't have any exports to pay for it. So this whole thing is going to come collapsing down. And that's why it was exceptionally dumb of Biden to sanction Russia the way he did, to weaponize the dollar's reserve currency status in a way that was like a wake-up call for the world get out of the dollar. You guys are, you're taking a huge risk because we could just turn that against you. It's like you're putting a noose around your neck, and then you're throwing the other end to the U.S. government, and you're hoping that they don't yank it, right? And so countries want to get out of this. And the mistake that people are making is just assuming that the dollar is going to stay the reserve currency because there's no other fiat currency that could replace it. And that may be true, right? The euro shouldn't be the reserve currency, the yen, the RMB, the pound. There's no currency that should replace the dollar. What should replace the dollar is gold, real money, because the dollar was the reserve before gold was the reserve. And when the dollar became the reserve currency in Bretton Woods, it was on the condition that it was not only backed by gold, but redeemable in gold on demand. So we had to make the dollar as good as gold for the world to accept it. But we broke that commitment in 1971, and we never returned to the gold standard. So it's just a piece of paper. And so the dollar's days as the reserve currency are numbered. And that means America's standard of living is numbered. I mean, we're going to see a huge collapse in our living standard because now we're going to have to produce things in order to consume them. And, we just can't do that anymore. I mean, what might save us eventually is a productivity boom from AI, but, that could be on the other side of the crash, but the crash is coming first.
Well, it was actually right after that. It was somewhere in the 70s that the US dollar was like 80% of global foreign exchange. So that's kind of where it peaked at. It's about 60% right now. That's
probably less, but yeah, but it's at least 50.
Okay. Yeah, but so that's a 25% or 20 percentage points, whatever you want to call it, drop that it's taken here. But it took it over 50 years to get here. Do you think it's going to go much faster from 60 to like 0 or 10 or 20?
It's that old saying, how did you go broke? Well, slowly at first, and then quickly
all at once.
And so it's going to accelerate the pace as people now realize that they want to get out, and it's a rush to the exits. And the dollars, our percentage of global GDP is a lot smaller than it used to be.
It's going to keep getting smaller too, probably.
Our stock market capitalization is relatively high, but that's because our stocks are so overpriced. But if you look at the GDP, our GDP is significantly smaller as a fraction of global GDP than it was, when we adopted, Bretton Woods.
Yeah. But then timeline, when do you think we see the dollar losing a majority of that share? And where is that? Like, is it 10% of global reserve currency, or like, where do you see it going and when?
And I don't know. I think, look, there's going to be a time. I mean, we got close. We really got close in 2008 before the financial crisis, when the dollar index got to 70. When you could only get 80 Japanese yen with the dollar, and the dollar was really sinking. The financial crisis actually kind of, gave us a reprieve. But I think that's going to happen again, whereas the dollar really starts to fall, and it really starts putting a lot of upward pressure on long-term interest rates and consumer prices. And it's going to put the Fed between a rock and a hard place that there's no way out of. And then all of a sudden, there could be a run on the dollar. It's like the emperor has no clothes. Years and years, and everybody pretends that the emperor's got this fine suit of clothes, and finally one kid says, I don't see it. He's naked, and then everybody, yeah, he is naked, right? Everybody admits it. And I think that's the situation with the United States. I mean, we know that the debt is unsustainable. We know that. Everybody knows that. We're broke, but nobody thinks it's a problem yet until it is a problem. And then it's it, right? Then it's a crisis. It goes from a potential problem to an immediate crisis, because now the people who were content to hold the dollar because they thought, well, the problem's not going to happen for a long time, so, I can stay here. Once they realize, oh, it's happening now, I got to get out. And so all of a sudden there's a rush for the exits, and, there's no way everybody can get out, because the only way that you can sell your dollars is if somebody else buys them. Well, if people don't want them anymore, who's going to buy them? And so it's going to fall apart very quickly. It's not going to be like an orderly kind of slow thing where they're going to just change over from the dollar to gold or something. It's just going to happen in the market. The dollar's just going to crash. The only question is when, and that I don't know because I've been very early in this trade. I mean, it should have crashed 10 years ago, but the fact that it didn't just means the crash when it comes will be worse because the problems are bigger. The bubble is bigger. Instead of fixing the problems for the last 10 years, right? We made them worse, right? We've been digging ourselves into a deeper hole instead of that's the first rule of holes is to stop digging, right? But we haven't stopped digging, and now we're in the Grand Canyon.
Hmm. What do you think replaces it though? Is this some kind of an Orwellian, like a World Bank digital currency or something like that? What do you think replaces the? Because some things got to be the global, the majority of global foreign exchange. What is it going to be?
No, I mean you could do all your gold exchange based on gold. I mean it worked very well before the dollar. It'll work even more or better now with the internet and the communications we have. It's very easy for gold to function as money now, much easier than it was in the past. Because in the past, they printed paper, so we had currency backed by money because it was easier than dealing with actual money. Because you didn't, you could leave your gold in a vault and you can, trade, transact in paper, right? That was backed by the gold. And they had private currencies before they had government currencies, but all of it backed by gold. But now you could issue a digital currency backed by gold. Right? You can tokenize your gold, and either the government can do that, right? The government can issue a currency backed by gold, or private companies can issue their own currency backed by gold, and then those tokens can easily be used in commerce by everybody. Anybody with a smartphone can make payments in gold. So it's never been easier to go on a gold standard than it is right now. And so since a gold standard works, and it's never been easier to implement one, then obviously we're going to do it. But governments will resist it because gold takes away their power. Right now they have to be honest. When you're on a gold standard, you can't lie to the public. You got to balance the books. You can't promise people something for nothing because what they need needs to be paid for, and you need to pay for it with real money. You need the gold. You just can't, run deficits and have the Fed print money.
Hmm. But having that digital currency that opens the door for again, thinking about an Orwellian future here. That's not something I'm looking forward to. So doesn't
Yeah, I
that
mean,
open
the
a door for?
governments can obviously abuse the digital currency.
Hmm.
So I think that it's important that if the government ever introduces a digital currency, that they also have the paper currency, but it should all be backed by gold. And they should also allow you to deal in private currencies. If you don't want the government currency, you should be able to utilize a private currency.
Hmm.
But again, that's just an ideal world in a free market oriented government
Hmm.
where you'd have that.
Yeah. Well, in that case, would that necessarily have to be backed by gold, or is it just something they issue on your phone or in
Well,
your bank
you
app?
got to back it by something because intrinsically it's worthless. So, I mean, that's where currency derives its value from the money that backs it up. Now, fiat currency derives value from the state because the state decrees it is legal tender,
Hmm.
and they demand it as payment of taxes. So taxes are a forcible extraction. If you live in a country and the government has a tax, you've got to pay it. And
Hmm.
if the government says this is what we'll accept in payment of taxes, you've got to pay us these dollars or these euros, and if you don't have the dollars to pay your taxes, we're going to lock you up, right? Well, now there's a real incentive to accumulate dollars. So that gives the dollar some value in that you need dollars to stay out of jail, right?
Hmm.
But the dollar itself doesn't have any value. I mean, what gave it value in the past was that it was gold. It was the gold that gave it value. It wasn't just that the government wanted you to pay taxes in it. It was actually gold. In fact, originally, the dollar was a weight of gold. That's what the dollar was. It was a measurement of a particular weight of gold or silver in the United States because we were dual metallic. Gold and silver were legal tender, and there was a rate.
Hmm.
But I don't even remember what your question was.
It almost feels like this is a racket with the government, but I feel like if I open that door, we might be talking in 4 hours still, and I feel like you might have better things to do today than talk to me. And well, I suppose I have one more question here. This actually comes from the comment section on your last appearance on Resource Talks, where someone said like, okay, all this is all and well, and like his thesis and theories there, but why are you giving this guy a platform to begin with? He's just a gold salesman. He makes money when you're buying gold. Obviously, not a very kind comment, but how do you answer to that? And maybe how do you manage that balance between being a gold salesman and being bullish in gold?
Well, I suppose if I was an employee of Schiff Gold and I just took the job because it was, the best job I could get, maybe I would be selling gold even though I didn't believe in it, but it was how I paid my rent. But I established Schiff Gold because I believed that people should buy gold. I started it around 2000 and was it 10 or 11 or 12? I forget when I started it actually.
Hmm.
But the reason I did before I even had Schiff Gold, I just had a broker dealer, Euro Pacific Capital, and I was getting people in the stock market. But I always thought that people should have gold too, like 5-10% of whatever their portfolio is. They should have some money in gold. Right? And so I would tell people, go out and buy some gold, and go to a gold company and buy gold. I didn't really have any one that I was recommending. I just figured, shop around, right? Find it. But what happened was a lot of people were getting ripped off. I was hearing a lot of stories about people overpaying for gold. A lot of these companies, were bait and switch, where they would advertise certain gold coins, but then when you called up, the salesman would push you into these overpriced, fake numismatic coins. And so I didn't like people, buying gold because I told them to, and then getting ripped off by a salesman and other firms. I said, look, I'm going to start my own firm, and I'm going to make sure that everybody gets a good deal. I'm not going to sell these numismatic coins. I mean, I'm not selling to collectors. This is for investors, people who want to preserve wealth and they want to hold gold as a savings. And so I set up Schiff Gold so that people would have a reputable place. And I knew everybody that goes to Schiff Gold is going to get a fair deal. No one's going to get ripped off at my company because I don't allow it to happen, right?
Hmm.
And so that's why I'm recommending it, is because I believe people should own it. And so I'm just giving them a place where they can go and buy it and not have to worry that some slick talking salesman is going to be giving them a BS story to get them to buy some other product. So, some of these markups are huge. I mean, there's some of these companies where you spend $10,000 on gold and they sell you $5,000 worth of gold, and the other 5,000 goes in their pocket, right? They make a huge amount of money, but now you need the price of gold to double just to break even on what you bought. But at Schiff Gold, maybe out of the $5,000, maybe $200, goes to Schiff Gold. And of course, we have to use that to pay our all overhead, right? So you get $9,800 worth of gold for your $10,000. So we're working on a small margin, and we're trying to make the profit on volume as opposed to trying to rip people off. That's why, most of the gold companies who advertise on television, pretty much all the companies, are ripping you off because there's not enough demand for gold to pay for an ad on like Fox News and then make enough money on your gold to cover the cost. Or when you see these celebrities or talk show hosts, right-wing guys that are saying, call this gold company, they're the one I like. Well, that company is ripping off their audience because what you have to pay these big conservative names to recommend a gold company, because you don't get enough volume in order to pay the cost of that recommendation, you got to rip everybody off. And so we don't have it. Schiff Gold does no advertising, has no spokesman other than me, and I don't get paid anything. So they don't have to, mark up the gold to cover the cost of paying me because I don't get paid. I mean, I get paid at the end of the day. If there's a profit left over, I get profit, but there's no upfront cost that you have to overcome. So we're able to keep the costs very low. And my goal is to just make sure that people own gold and silver because I know they need to own it. But I think it's interesting too, because I notice that a lot of times people will say, especially when back in the day when I used to go on CNBC and I talk about gold, they would always say, well, Peter, you sell gold. You're not objective. I mean, come on. I mean, you don't really believe this stuff, right? They would always say that to me, and I'd have to defend myself. And I'd say, but you get stockbrokers on here all the time, and when they recommend stocks, you don't just say, well, come on, you're just a stockbroker. You're just trying to sell stocks. And I would say, most of my business, I'm a stockbroker too. Gold is a side business for me. In fact, I make more money when people don't buy gold, right? If you send me money to manage and I charge you 1-2% a year, I make a lot more money. If a guy sends me $100,000 or $250,000 and puts it in a managed account or buys my mutual fund, I make a lot more money if they do that than if they buy gold. But I still recommend gold because I think people should own it. So they would always, say this stuff to me and question my objectivity and say I'm just a salesman, but they never would raise the same points with all the stockbrokers that are coming on, talking their books. But now, and for the past, couple of years, you get all these crypto people coming on CNBC who own a crypto business. So their whole net worth is wrapped up in crypto, right? And they come on there and they say, Bitcoin's going to 1 million, right? Bitcoin is the greatest. Bitcoin solves everything. Bitcoin fixes everything. It's going to have the market cap of gold. It's going to have the market cap of the stock. I mean, all kinds of pie in the sky, crazy stuff. And they don't push back. I've never, ever heard a host say, aren't you just saying that because you're in this industry and because you need people to buy Bitcoin? Because if they don't, the price is going to crash. Because Bitcoin is actually a pyramid scheme. You have to promote it. You have to constantly sucker people into buying it, or the whole thing implodes. And I can't have any impact. You go on television, you start touting, this stuff. You could actually get the price to move. Nothing I say is going to impact the price of gold. I mean, the gold market is so big and so deep. I can go on television all day long and say gold's going to 1 million, and it's not going to impact the price. But you go on there and talk about Bitcoin, I mean, some people buy it and the price could really jump. Now, it's not jumping as much as it used to because the big guys are trying to get out, right? They're selling into any rally. That's why the price hasn't gone up in the last few years, because the real money's getting out. It's the suckers that are coming in. But the smart money has been quietly buying gold, right? Everybody's distracted by this sideshow in fool's gold, AKA Bitcoin, and they're missing out on the real event. And one of the reasons that Bitcoin got so popular was it got popular during that 10, 12-year period where gold did nothing. Gold went sideways. So people were getting frustrated owning gold. And now they say, hey, well, just own this. This is better. This is Bitcoin. This is digital gold. This is gold 2.0. Look at how much, while you've been sitting in your gold, Bitcoin's gone from, a penny a Bitcoin to 60,000, right? Why don't you cop on this? This is the fastest horse. You're wasting your time in that analog, grandpa gold. This is the new gold for the millenniums, right? And so there were people that bought into this nonsense. But now that gold is moving up, and as gold continues to move up, more and more people are going to be content to hold gold. And a lot of people that made the mistake of changing horses, right? They're going to see gold continuing to rise and Bitcoin going down. They're going to want to get out of their fool's gold and get back into the real thing. So this is the trend. And eventually, of course, Bitcoin's going to crash, especially when all the people who own Bitcoin ETFs try to get back into the gold ETFs that they sold to buy the Bitcoin ETFs. Because they're like roach motels, right? You could check in, but you can't check out. If everybody, or a lot of people try to redeem, that'll crash Bitcoin. Because the Bitcoin ETFs have to take the Bitcoin. If you start selling those ETFs, they got to take the Bitcoin and sell it into the market that day at the market. And there's not enough buyers. And normally what happens when Bitcoin is crashing, you'll have Tether. You'll have a lot of people, show up with Tether. But when the ETFs are selling, the buyers can't pay with Tether. They have to pay with actual dollars because Schwab or Fidelity can't put Tether into its customer's brokerage account when they sell their ETFs. They have to give them actual dollars. So that's going to really diminish the buying. So, this next crash is going to be, a spectacular collapse. And it could happen any day, right? You're just, playing with fire if you own it.
I'd like to see you talk to Dave Ramsey. I think he, to your point, that like nobody ever pushes back on him when he says, gold's got no yield, it generates no cash flow, it's got storage costs, it's volatile, you shouldn't touch it. That's in broad lines what he says when he
Well, here's
advises
the thing
against
about
gold.
Dave Ramsey. And he was very critical of somebody who called up his show in 2007, who read my book Crash Proof, and I talked about, he said, oh, that crash, that can never happen. And of course, everything that he said could never happen happened. But what Dave Ramsey makes the mistake of doing is comparing gold to investments like stocks or real estate or bonds. And gold is not an investment. I've never said it was investment, right? Because it doesn't have a yield. He's 100% right. Gold is money. So you have to compare gold to dollars, cash, euros, cash, yen, cash. So if you don't want to make an investment, if you just want to stay liquid in money, what do you want to own? Do you want to own dollars, euros? Do you want to own gold? Gold has a great track record against other government-created, monetary substitutes. If you look at where gold was when the Federal Reserve was created in 1913, you only needed $20 to buy an ounce of gold. Now you need $2,500 to buy an ounce of gold. So gold has lost more than, the dollar has lost more than 99% of its value since we turned it over to the Federal Reserve. So clearly, gold is better than dollars. Right? So if you want to be liquid and you want to have savings in cash, you're better off in gold. But it is not an investment, right? It is a form of money. Now, if you loan your gold out and somebody pays you interest, well, you can turn it into an investment, but you got to make the loan. But when you make a loan, you're taking some risk, right? Maybe the guy who borrowed your gold won't pay it back. So most people who are buying gold are willing to give up the yield for the security, for the safety. I'm going to get my yield someplace else. I get my yield in stocks. So I buy a lot of dividend-paying stocks that are giving me plenty of income. And I have real estate that I rent out. I collect rents, right? So, but what do you do if you think real estate prices are too high? Maybe you want to hold cash and wait for the price to come down so you can hold your cash in dollars, waiting for a good buying opportunity to buy more income-producing real estate or more dividend-paying stocks. So he has to think about it in those terms. Right? And when you put it in its proper perspective, then yeah, it makes sense to hold gold. And of course, the more expensive stocks are, the more gold you want to hold, right? Let's say stocks are really cheap. Let's say the market crashes and you can buy stocks at 6-7 times earnings with the 8-9% dividend yield. Well, you'd want to go all in, right? You don't need to have a bunch of gold. But if stocks are trading at 30, 40, 50 times earnings and the yield is insignificant to zero, all right, well, maybe you don't want to have a lot of stocks at that point. I'd rather own more gold. I'm not really giving up much yield by owning gold because the stocks are barely yielding and they're so expensive. I'm going to wait for a better opportunity and then I'll buy. So it's an apples to orange comparison when you try to say gold's not as good as stocks. Of course, over the long run, it's much better to make an investment than to hoard cash. But if you overpay for stocks, if you overpay for real estate, it can be a disaster, right? So just because stocks are a good investment doesn't mean that whenever you buy them, it's a good investment. Because if you overpay, you could end up losing a lot of money. Even though stocks in general are a good investment as an asset, it depends on the price that you pay for them.
Well, actually, this goes back to the first question that I opened it with. But to summarize everything we've talked about here today, essentially, you don't think it's too late to start or grow a position in gold here. That's kind of my takeaway.
No, this is early days. Gold is cheap. Now, people might look at gold and say, oh, gold is expensive. It's $2,500. But no, because you have to look at it in comparison to the money supply, to the dollar. Gold at $2,500 is actually a lot cheaper than it was 20 years ago, I think, when gold was 300. Look at, that was, before we blew up the balance sheet with all this QE. I mean, before we had this massive amount of debt. So it's all in perspective. And of course, look at where the stock market is. I mean, the stock market, Dow was 40,000. In the year 2000, it was 10,000, right? So, everything you get is more expensive. And now you're starting to see food is more expensive, right? Gasoline, insurance, healthcare. The price of everything is going up. So the price of gold's got to go up too. Well, what's really happening is that the prices are staying the same. It's just that the dollar is going down. The dollar is losing value as the supply increases. And so you need more dollars to buy food. Well, you also need more dollars to buy gold. But what happens is as people start to realize how much inflation there is and how much value the dollar is going to lose if they hold it, they want to get rid of their dollars and they want to have a store of value, and that's gold, right? People think, well, Bitcoin is a store of value. No, it's not, because in order to be a store of value, you have to start off with value. Right? Bitcoin doesn't have any. Gold's value is that it's a very useful metal that has properties that give it a lot of value. And so when you own gold, you own those properties, and somebody could take that gold in the future and use it to make a computer chip, or use it to make a piece of jewelry, or use it, for a dental implant or whatever, or an aerospace. There's all sorts of uses for gold, and there'll probably be a lot more uses in the future than there are today. They're always discovering new ways. I mean, they use gold in medicine. And so since gold doesn't lose any of its properties, it stores all that value indefinitely. And so as inflation really starts to accelerate, people are going to want to get rid of whatever they don't spend. And where are they going to park it? They can park it in gold. And that's when you're going to really see the demand picking up. So right now you're buying 2,500. Look, I think 2,000 is the base. That was the floor. And so if you're buying it at 2,500, you're only 25%, right, above the floor, right? So if gold's going to go to 10,000, 20,000, 40,000, 2,500 is pretty cheap. So look at it in those terms. Not, gee, it's expensive compared to where it was, but it's cheap compared to where it's going. So people should contact Schiff Gold. We just started recently. I now have e-commerce on Schiff Gold. Up until a couple months ago, the only way you could buy gold from Schiff Gold was to talk to an actual representative. We didn't even have the ability to just, fill up a shopping cart. But I changed that. And so now, 24/7, you can go to my website. The products that I recommend are there. The prices are there. They change. They constantly update with live markets. But you can look at the gold and silver. You can put in your information, load up your cart, check out, and we'll mail you your gold. So just shiftgold.com is the website. And again, if you want to be more aggressive and get into the mining stocks, you could buy my gold fund, Europe Pacific Gold Fund, EPGIX. That's the no load. We have a load version, but if you're working at a discount broker, no point in paying the load. Just buy it no load. That's the commission. So if you get no load, you get more shares for your money. Or contact Europe Pacific Asset Management. The website is europac.com to talk to my representatives about separately managed accounts, not just gold, but all my strategies: value, dividend payer, emerging markets, foreign bonds. And also, in addition to my own podcast, I now have a free newsletter that comes out pretty much daily. You can subscribe to that at shiftsovereign.com. And then we also have a premium newsletter, so you can learn about that if you want to, kick in a few bucks every month to get the premium newsletter. But all that's a new thing that I just got into, but that's shiftsovereign.com.
Well, it seems like sleep's not on the menu for you though, Peter. Seems like you're doing a lot there. But thank you again for investing your time with me, sir. I will let you drop off now, as I know you have to run, but I also have to be moving over to my favorite part of this Real Money Talks episode, and that is, of course, the disclaimer, right after which I will jump into the CEO barbecue, of course, but you don't want to miss it. You don't want to skip this disclaimer, not your usual disclaimer, although there is a warning on your screen right now that you are obligated to read, but you're better off reading that, actually putting a couple of minutes into it, reading it and understanding what that means, because it's dangerous out there. This is, again, not just some disclaimer. This is an actual warning that I think will help you not lose money, which, by the way, is the norm and should be the expectation in the sector. And so you should not risk any money that you're not ready to lose completely. Part of it as well is that I'm here to make money. Okay, I make money from the existence of this channel and specifically from companies paying for the production of these interviews. Now, in this episode specifically, none of the companies that you'll see have paid to be here. Those are free interviews. I'm not being compensated to produce or publish them, but that doesn't mean you should look at this episode any different, because even the companies that are not paying are still likely seeing their interviews or their participation in this program as a chance to do some marketing. So I'll need you to start by understanding that most company communications online, albeit interviews or their presentation or what they're putting on LinkedIn, what they're putting on their social media, whatever there might be, all of it, like conferences, when you speak to them, when you call up the number that's on their website, all of that on the other end, your counterparty sees that as marketing. And although, well, I don't make buy or sell recommendations on this channel, or anywhere for that matter, because there's a clear conflict of interest with the line of business that I'm in. There is a clear conflict of interest between taking money from the companies and then making recommendations. Many out there will do that though. And so you should be aware of that inherent bias. That bias will not always be clearly disclosed with everyone out there. So whether it's interviews, whether someone's just making a video about a company, whatever it is safer for you. And just anytime you're watching, consuming any type, listening, whatever you're doing with the content, anytime you're consuming any type of company specific content or content that mentions a public company, approach it with a dose of skepticism and treat it as marketing. Understand that you're seeing the best side of the story. And do further research beyond that. Don't rely on any of that. Don't rely on marketing, just like you wouldn't rely on other marketing. When you see an ad on TV for a product, you do your own research before you get that product. Treat that with even more caution, because your money's on the line here and you risk losing all of it. Now, fortunately, I'm not a magician. The guests here are not psychics, and some of the CEOs are even normal people. So we don't possess any superior knowledge about what's going to happen in the future. We don't know what's going to come out of the ground. We don't know what's going to go up, what's going to go down, and what's going to go in circles. Nobody knows that. So no guarantees are going to be made here, besides that there will be, and that is the only guarantee that you're going to get here, there will be forward-looking statements in these conversations. Those are conversations that are general and impersonal in nature, containing hopes for the future that may or may not take place, depending on many different factors, both within and outside a company's controls. Be aware of that. Be aware of the inherent risk to investing and the increased risk of investing in non-revenue generating companies that are operating in the harsh reality of the mining and exploration industry. And please don't rely on any of that. Go and talk to someone who's proven to know what they're doing. Go and talk to a professional investment advisor, someone who's licensed, has the credentials and the proof that they know what they're doing, as well as just do more research yourself before taking any decisions. Go to setterplus.ca. Don't let yourself be FOMO'd into anything. You've got plenty of time to go to setterplus.ca, where you're going to find the official company filings and research them. You want to look at the management information circular. That's going to tell you how much money the company executives are making. You want to look at the management discussion and analysis. That's short for that is MD&A. You want to look at the financial statements. And then typically, if a company is well advanced, they're going to have an NI 43-101 document that is a technical disclosure that you can go and read. Just read them. I know you're not a geo. Most of us are not geo. I'm not a geo. I spend time reading these things, and over time it gets easier. But you pick up on bits and pieces. Sometimes something seems strange. You write down the question. You email a company with that question, or you find someone, find a geo or whoever online who's talking about these things. Again, knowing that they're probably biased, and ask them, and do that work. And of course, again, just talk to a professional investment advisor in the end, though. The disclaimers on your screen right now. Again, if you don't enjoy losing money, read them. Be careful out there. That's it. Shutting up now. Well, not quite shutting up, because I'm going to actually be kicking off the CEO barbecue portion of today's Real Money Talks. And I'm going to do that by traveling to what looks to be an up-and-coming jurisdiction that nobody's really talking about unless it's uranium related, which this time it isn't, and that's Kazakhstan. But I'm not going there to drive around in Ladas, although that is a lot of fun. I've done it as a kid, and I can confirm it is a lot of fun. They're not the most comfortable vehicles, but they can be fun. But this time, I'll be looking for gold and copper, and luckily, I'm not going to be doing that on my own. I'm getting help from Tim Berry, the CEO of Arras Minerals. The company is listed as ARC. That would be ARK on the TSX Ventures Exchange in Canada, where an average of about 57,000 shares trade each day. with a 52-week high of 56 cents and a 52-week low of 12 cents. With a market cap of just under $35 million and just under 90 million shares outstanding to date, this is a 37.5-cent stock. There are about 12 million warrants, and after the recent financing, that is, and there is 5.5 million options outstanding, leaving the number of fully diluted shares at about 106 million. About 2 million of those warrants, by the way, expire in October of next year. So they were from a previous financing. They are exercisable at 60 cents. But so the majority of the warrants outstanding, a little over 10 million of them, are related to the last financing that the company did in June of this year. They are 3-year warrants, so they expire in June of 2027, and they are exercisable at 40 cents. With this most recent financing, Tech Resources now holds over 9% of the company. Insiders here own 7%, and another 9% is owned by associates thereof. The last financial statement, which is dated April 30, and so does not incorporate the recent $5.3 million financing, shows me about $950,000 in current assets, again, at the time, at the end of April, and $720,000, again, at the time, was in cash, and there was $215,000 in prepaid expenses, most of which related to insurance payments. No long-term debt was recorded for the first quarter of the year outside of an $80,000 lease liability, and short-term obligations came in at about $1.5 million in total, although that does include a liability that is related to Tech's spending commitment, which I'll tell you more about in a second. But it also includes over $600,000 worth of account payables, about $380,000 of which is due to officers and directors of the company. And apparently that balance is expected to be settled in RSUs instead of cash within 1 year of this April publication. You might also see a $135,000 current obligation due to related parties. That's not due to insiders. That's actually due to Silver Bull, and it is from shared employees, office expenses, and whatnot. So that's to be repaid on demand, although, again, after the recent capital raise, that should not be an issue. In terms of corporate expenses, the same financial statement shows me that without counting the share-based compensation and depreciations, of course, ARK spent an average of $125,000 per month over the last reported 6 months on what I would call administrative expenses, where personnel and directors combined accounted for about 70% of that administrative spend. About 15% was spent on marketing, and another roughly 15% was spent on professional services and offices. That is, again, only the administration spend. As for the exploration spend, that came in at an average of about $110,000 per month for that same 6-month period ending on April 30, 2024. And so that is indeed less money spent on exploration over the last reported 6 months than what was spent on administration, with there being a roughly 45 to 55% ratio in favor of administrative expenses. Why that is the case will make more sense in a minute, but as always, please understand that this financial statement is nothing more than a snapshot in time. Okay, this case, it was specifically at the end of April of this year, and it doesn't really show you much. It simply shows you what the finances look like on that exact date and nothing more. Finances, though, are a fluid thing, and I could also be making mistakes in my reading of them. So by the time you're watching this, please head over to the company's website as well as setupplus.ca to look at all the numbers yourself and make sure you're getting the full picture. Now, for ARK, that full picture, as I said earlier, is solely focused on Kazakhstan. Part of the reasoning for that is that when you compare the Kazakhstan porphyry belt to other famous porphyry belts like the one in Arizona or Chile or Peru or the Philippines, the number of discovered porphyries on this belt to date is about 90% lower than those ones, meaning on that 500-kilometer part of the Boshikal belt, that's the porphyry belt in Kazakhstan, there are only 3 porphyry deposits that are now discovered, whereas within 500 kilometers of the other 4 ones that I mentioned, there's an average of 26 deposits, with, of course, the most talked about and probably the most worked on to date being the Arizona-Mexico belt, which is, of course, pulling this average higher with 37 discovered deposits, some of which are operational already, of course. So this is all to say ARK believes this is, and here comes everyone's favorite promo words, but underexplored elephant country, because this is what it actually is. One way they're targeting this, or have been targeting it, is by acquiring a lot of ground, which has resulted in them now sitting on a combined surface of over 3,300 square kilometers of land. That's square kilometers, not square meters. And that is in a handful of non-contiguous properties. So they're not next to each other, but there's a bunch of them. I'll go through some of them, not all of them. But the LMS property is the most advanced one of the bunch, and it covers over 530 square kilometers of land. There's been a ground IP survey recently conducted. The results are due shortly. That's going to be interesting to see. And it's also going to help them with targeting for an upcoming diamond drill program. Geologically, this land package was mineralized by a series of dioritic and monzodioritic intrusions, with the host rocks being intermediate volcanic and sedimentary rocks, which, besides making me look like I know what I'm talking about, which I don't, it also means relatively easy to mineralize rocks. That's why I'm bringing it up. And so the idea is to find multiple copper gold porphyry deposits on this package, with the potential for peripheral high-grade epithermal gold and silver systems as well. There is some historic drilling dating back to Soviet times in the 1950s on this project, when a large geochemical anomaly was discovered and then tested. But not very much has happened here in modern days outside of Arras making 2 new copper and soil anomaly discoveries recently, to the tune of, and I'm rounding up, 9 kilometers and 14 kilometers respectively, which in my people's terms translates to very big anomalies. The names of those 2 targets are Bereski. I'm telling you because that might keep coming back in the conversation. That is the 9-kilometer one. It's actually 8.8 kilometers to be specific. And then Amandai, which is the 14-kilometer one, with historic drill results from the former showing highlight intercepts of 127 meters of 0.66%, copper, 133 meters of 0.80, and 70 meters of 0.5% of copper equivalent. That is, so it is CuEq. Arras also re-assayed some of the more recent historic drilling dating back to 2007 and 2011, with highlights from that re-assaying of the core coming in even better than the previous ones. And there was a highlight of 108 meters of almost 1% copper equivalent, although that specific intercept was made up by 1.3 grams per ton of gold and 1.5 grams per ton of silver on top of the 0.2% copper intercept. So if gold equivalents please you more, in that case, that was about 1.13 grams per ton of gold equivalent, which was within a larger, almost 300-meter interval of 0.44 grams per ton gold equivalent. Again, that is with that historic core showing very strong porphyry-style mineralization, nicely visible in some of the pictures on the company's presentation. This has not yet been drilled by ARC, though, as I said. So this is where drilling is expected to begin next, but more about that later on in the conversation. Currently, though, Arras is drilling in another target. This one is called Tay, and it is about 30 kilometers away from an operating mine that produced about 120,000 ounces of gold and over 100,000 tons of copper in 2022 alone, with mine life, as far as I understand it, extending to about 2054. Tay is also a large project, and it also hosts a large anomaly, only this is a geophysical anomaly to the tune of 6.5 by 2 kilometers, which you already know what my people would call that, but it is something along the lines of very big, and similar in size to the nearby mine, or the anomaly of that nearby mine, at least. Worth noting, though, that there is a colluvial cover here that is between 10 and 40 meters in thickness, so it has never been drilled before, which is why ARC is now conducting a 100-hole, 5,000-meter drill program using KGK drilling with the purpose of sampling just the top of the bedrock through the overburden and figuring out why there is an anomaly there in the first place and see if it's really worth drilling or not. This is cheap drilling, though. It's not yet diamond drilling. As I said, it's KGK, so it won't tell them if there is a mine there yet, but it will tell them whether diamond drilling is worth doing. And in the case of there being proof of hydrothermal activity or porphyry-style mineralization, then they could follow it up with diamond drilling. But again, more on that later on. Over in northeast Kazakhstan, ARC hosts over 600 square kilometers of land spread across 2 properties, the main importance of which being that they're actually surrounding the Beskauga deposit, which ARC has an option on, where they have up until 2025 to put down $15 million, and that's 15 million US dollars, and purchase 100% of what is a resource stage project that's already seen almost 50,000 meters of drilling, which has resulted in almost 600,000 tons of contained copper, spread almost evenly between the indicated and inferred categories of the NI 43-101. Copper is not the only thing, by the way. Oh, grades of copper, 0.3 and 0.24% respectively, with a nice half a gram gold credit, as well as some silver, And also when I say some across the two categories, I'm talking about 8.2 million ounces of silver and almost 3.5 million ounces of contained gold. But ARC believes there is much more than that down there because the same type of drilling, so KGK drilling, which is currently ongoing at Tay, has happened here already, showing anomalous copper and gold over a 4-kilometer strike with mineralization remaining open at depth and, of course, requiring further drilling. But we'll talk more about if that's going to happen later on in the conversation. I do realize I'm talking too long already, so I'm about to shut up. But there's one more detail, not an unimportant detail either. That's the Teck involvement here in the company. So I mentioned there's a 9% ownership that Teck has taken into the company in December of 2023, though. So next to the ownership, ARC also formed an exploration partnership with Teck, which does not include any of the 3 projects that I talked about earlier. Essentially, with this deal, and it's a bit more complex than what I'm about to make it sound, but in broad strokes, Teck has selected about 1,700 square kilometers of land on which they'll spend about $5 million worth of exploration dollars by the end of 2025, which will give Teck the option to choose 4 properties out of that 1,700 square kilometer package. And those 4 properties should be covering no more than 120 square kilometers. So less than a tenth of that overall ground that they're going to look at. Where after that, they are going to have to fund close to $50 million, so 50 almost, of exploration expenditures per project. So that's $190 million worth of exploration spending on 4 projects that are totaling, again, 120 square kilometers, which, if completed, will then give Teck a 75% interest in each project. So an effective free carry for Arras of 25% here. There's also a $1 million reimbursement involved in this deal, but with the amounts I was just talking about, it almost feels doesn't feel like it's worth talking about. And also worth noting, Arras has until December of this year to manage the projects, after which Teck has the option to become the manager of these projects as well. Suffice it to say, there's plenty to talk about already, and I've not covered most of it, but if I did, I'd be talking for a couple of hours. And right now it does feel like a wonderful time for me to be shutting up. So I'll open up the conversation here, Tim, with an obligatory CEO barbecue question for first timers. But who are you and why should I trust you with my money?
No, well, I'm a New Zealand geologist, and we like barbecues down there, so I'm happy to get those kind of questions. So I'm a New Zealand geologist. Much like most New Zealanders, we would head off to Australia to seek our fame and fortune. I chose to head up to Canada instead, and very quickly got involved in the mineral exploration business there, and spent the 20 years essentially traveling the world, initially looking and working for juniors, looking for copper and gold mainly in North and South America, Mongolia, Africa. And then eventually I settled with a company called Dome Ventures, where I set up and ran a number of projects for them in Africa, so Central Africa and West Africa, mainly looking for gold. And from that, we leveraged one of our projects into a very good project in northern Mexico. And so I stepped over to run that project in northern Mexico. It was with a company called Silver Bull Resources. And it was Silver Bull that eventually morphed into Arras. And the reason why Silver Bull morphed into Arras was, like a lot of projects in Mexico, we unfortunately ended up under a blockade with a small group of locals who had a local mining company decided to try and extort us by blockading the road and not letting us access the project. And that gave us the opportunity to seek another project, and this is how we ended up in Kazakhstan. So to cut a long story short, we'll go into that a bit more. I've spent basically the last 25 years working all over the world, running big programs and I guess financing them mainly out of Canada.
What were the three last companies that you were involved with? So Silverbow Resources is one of them. What were the other ones before that?
Yeah, so Dome Ventures, which became Silverbull Resources,
Okay.
which eventually became Arras Minerals. So I've spent, I would say, now we're looking at 15 years with effectively the same group of shareholders and management. And then prior to that, it was a sort of journeyman's type approach of working for juniors around the world, more chasing location and interesting projects and rocks, as opposed to, I think, trying to zero in on one particular area.
Okay. What do you think that's resulted in terms of net worth for you? And specifically why I'm asking that is because I'm interested how important Arras Minerals is to you. Like, what percentage of your net worth would you say is tied up with this one specifically?
Yeah, I mean, look, I think to really get rich in this business, I think you've got to have two wins. The first one gives you, the walk around cash where you don't care, and then the second one is where you can get huge, meaningful positions in a company, and then I think that's when you really clip a serious payday. So, in terms of net worth, it's by far my biggest portfolio project by a long way. But I'm an avid investor, particularly in the mining business as well. So, I run a fairly extensive stock portfolio of companies and projects that I follow. So, do I want Arras to be a win? That would be a huge success for me. But equally, I'm not. I'm not. I'm always looking to evolve a project. If it's not going to work, we go and seek something else for it to work on.
How significant part of your portfolio is ARC, though? Is it, what are we talking about? Double-digit percentage? Is it half of your portfolio? Is it a couple of percent?
Oh yeah, easily double-digit percentage.
Okay,
yeah,
good. Are there any other incentives besides that for you? Like, are there royalties in the projects that you own, or a drilling company, or a helicopter company that is servicing Arras, or something along those lines?
No. We obviously incentivize everyone, including myself, with options. But outside of the stock standard, I think it's everyone's working just to hit it out of the park.
Yeah, so I don't think you get it, Tim, because you said there's two options, but there's a third option. You start a drilling company, you start a helicopter company, and then you charge Arras a 700% premium, and that's how you can also get rich in this business. Unfortunately, that's what a lot of people are doing. But let's jokes aside. Let's actually talk about how you plan to make yourself as a shareholder and me as a potential shareholder money here. And again, as I mentioned at the beginning, plenty of projects, plenty of ground. Quite a lot of ground, really. And then there's a tech partnership in there as well. So hopefully we'll talk about all that. But how can you get your hands on that much land in the first place if it's that promising? I mean, BHP, Glencore, Rio, Teck, half a dozen other giants are constantly looking around the world for new elephants, right? For new replacement of their depleting ore bodies. So how have they missed Kazakhstan? Why do they not own your land packages?
Yeah, that's a very good question. So the real answer is timing. So in June 2018, Kazakhstan completely revised its mining law to effectively resemble that of Western Australia, which they also looked at Ontario, British Columbia, Saskatchewan, and brought in some good parts from those mining laws. And what they forgot to do was tell anyone about it. And so they released this fantastic mining law in June 2018. Then COVID hit, so it suddenly became very difficult to get anywhere in the world. And this is where I think we got the competitive advantage, was we were undergoing due diligence on the Muskoka project at the time. And just prior to Kazakhstan shutting down and travel becoming exceedingly difficult, I actually got a special exemption to get into the country in order to look at projects. And it came with all the caveats of, getting locked up in a room for 14 days and everything. But when I was out, I was able to do two things: go and visit the projects on the ground and really dive into a lot of data at a time when nobody else could actually access it. And it became very apparent to me that in addition to the Muskoka project, which was the project that got us into the country through an option to purchase, the belt of rocks that we were in was effectively wide open for staking, due to, they cleaned up the license map in the country, and there was literally one or two other companies that actually had the infrastructure and the ability to stake new ground. So, fortune favors the brave. I think we got lucky with the timing, and the size of our land package sort of reflects that everywhere we looked, we just started seeing more opportunities. So we ended up staking close to 17 mineral licenses, some of them over 450 square kilometers in size. And the map is starting to get a little crowded now, but when you've now got a fairly dominant land position and a prospective belt, it's it allows you to then start expanding with smaller licenses as you learn more about the geology.
I do want to talk about some of those other projects as well later on in the conversation, and figure out if they might be in some sort of way helping you finance the company. But again, we'll talk more about that in the future. I also wonder, with that much ground, how do you even know what to do or where to begin? How do you know what targets to prioritize? What do you pick them based on?
So big pieces of real estate to explore has actually been a feature of my career. When I was working in Central Africa, in Gabon, we had a joint venture with Anglo Gold Ashanti that covered 20,000 square kilometers of basically virgin jungle. And what I learned during that period is what you're really trying to do is boil areas down to where you want your geologists to focus. So the first pass needs to be it's logistics of how do you target your geos into the areas of interest. So for us, what we're trying to do with a land package that big, either in Central Africa and now in Kazakhstan, is do a first pass where we'll cover it with geophysics, usually airborne mag, and radiometrics. We'll go out and we'll smash it with soils. So we've got a team of 50 soil samplers out in the field, and we're analysing that data real time. And out of that data starts to emerge areas of interest, and that's where your geologists go to obviously follow up with mapping and sampling and ultimately drilling. And so the whole approach is we're looking for low-hanging fruit that might just be sitting there, maybe under 10 meters of sediment cover. And we want to move quickly. And so you need two things for that. You need excellent logistics, and we've got that here in Kazakhstan in spades to be able to get 50 people into the field every day and feed them and get 600 or 700 soil samples back a day and analyze them in real time. That's actually all logistics. And then you need an excellent geology team that follows up the anomalies and the ability to triage things quickly. This doesn't look interesting, get rid of it. This requires more work, let's follow it up.
Well, let's maybe talk about, when you say more work, let's talk about more specific stuff then in that case, and approaching this maybe a bit selfishly from my perspective, but such is the world, I guess. What I'm most curious about are these large anomalies on the LMS project. Two of them, Beresky, of course, being kind of a focus here. Are those your main focus as well? Is that the main unanswered question this year, if you will?
Yeah, we've got our Muskoka project, which we can talk more about a bit later. That's definitely our most advanced project, and for us, that provides a nice underlying potential value to the company. But at the same time, we've got Alamus and also Tay, where we've put a lot of effort into getting those projects drill ready, and that's going to be the focus for the second half of this summer. As in fact, we've got drill rigs mobilizing as we speak, and we'll do a first pass drill program on both those targets, to effectively test the broad spectrum of what we're looking at, and hopefully that rolls into more of a resource definition program as we roll into next year, for example.
Okay, so what would you say on these two targets? What would you say is the main unanswered question?
Size and grade. We, particularly with Tay, that's a complete unknown. We don't know. The project's completely buried. We picked that project up by going through archives of Soviet data, and we recognized there was a very prominent IP chargeability anomaly that when we went up there, it was actually buried, and there was no information on drilling that had actually targeted it that we could find, at least from the Soviets, and certainly no evidence of any Soviet drilling in the area. So that project is kind of conceptual. However, we are following that up with ground IP, just to confirm that the IP target is real, and then of course drilling will be the next step. With Alamus and the two targets, Beresky and Imandai, again, they were first identified through looking at historical data, and we followed that up with our usual technique of getting out there and just smashing it with soils. And what very quickly emerged were very prominent copper, moly, and arsenic anomalies, which, we're using XRF to assess soil data. And those are the elements that are best identified. So there's probably more that we could find if we were to do full ICP, but the point is it really delineated the targets. And now we're following that up with focused geophysics, so ground IP again, and then the drill rig will answer the question. So sorry, to answer your question, what we're trying to do is confirm mineralization, confirm we've got a mineralizing system, and try and get a sense of how big this thing actually is.
Okay. That ground IP, I assume that's completed. You started a couple of months ago. That doesn't take too much time. When are you expecting that to come out? And are you expecting anything out of the ordinary here?
No, I mean it's underway. This is a big IP survey. We're doing 500-meter lines across the full 8.5 kilometers or almost 9 kilometers of strike. And then in particular areas, we'll probably do some infill IP lines. And, what I guess I can say is the response is not unexpected. And it starts to give you a sense of the kind of depth of drill holes we'll need to drill to really test the system in general.
Right. Okay. So with what I've noticed on the Beresky target, or what attracted my attention, was the Molly anomaly that you have right there. I suppose that's also going to be a priority for you now.
Yeah, well, that's one of the things that really came out with our soil sampling program, where we ended up with a classic scenario of a bullseye Molly anomaly that was effectively 2 kilometers by 1.5 kilometers in size, that corresponded perfectly with a depletion in manganese. So that's starting to give you a very typical porphyry response, and then also a very strong coherent or coincident copper anomaly. So if we were to assume that that's a representation, because we're only looking at soils here, so you never quite know how much elements have been transported around. But if you assume that that's a porphyry response, that's probably the hotter part of the porphyry, and that's where you would expect to get your copper and your most intense copper and Molly anomalies there. And that's never been drilled, which is the exciting part of it.
That's exactly why I'm asking about it, because as far as I understand it, and obviously not a geo here, but molybdenum typically forms in the later stages of a porphyry. But you're already seeing it here with the first go at your geochem. Does that tell you anything about the age of the potential sister, maybe even how deep it might be next to the other stuff that you just told me about?
Yeah, what that's possibly explaining there is, you're very close to the porphyry center, so I would expect, your porphyry to be at or very close to surface. And there's a number of ways you can get that to soil, as you have a volcano and your intrusion at depth. And to get it to surface, you've got to erode off all of that volcano and sediment that sits over the top, which in the classic system can be over 2 kilometers. The other scenario, and this happens in Arizona a lot, is you tilt the system and you end up with the system on its side, which, and this is an unknown for us, may explain why we've got such a prominent long copper anomaly that's over 9 kilometers or just under 9 kilometers in length, is maybe we've got a tilted system. And the drilling for us, that's one of the things we're going to be looking very intently at with regards to the rock, is can we get an orientation of the porphyry, because that starts to dictate how you might target drilling out the rest of the target.
And you're targeting to know the orientation of the potential. We don't quite know if it is a porphyry. I mean, expectations are high, of course, but you're going to know the orientation this year?
No, I think that's something that's going to be worked out over time.
Okay.
And it's going to require, I think probably this first pass drill program and really thinking about it, and then, in but all of that is fine so long as we're hitting mineralization, and I expect that we'll be doing that for sure.
Okay. What about then this year in terms of the size of the program? How many holes? How many meters? I know it's you haven't put anything out there, but can you give me an indication?
Yeah. So we're planning a 5,000 meter drill program, and in terms of the drill holes themselves, they're going to vary in depth depending on sort of what we're targeting and what we're hoping to achieve. But I'd be expecting to drill, a couple of 6, maybe even 700 meter deep holes in that, and then a bunch of 200 to 250 meter deep holes as we sort of try to test the system as a whole.
Okay. But you're not doing it deep holes, like no expensive holes, so to put it. But also, this is Kazakhstan, so I don't expect it to be too expensive. What are you paying per meter?
Yeah, this is the beauty of Kazakhstan. Is so our drill contract, we're drilling $100 a meter, with another $25 on top of that for assay. So if you take that cost advantage, $125 a meter, a 5,000 meter drill program is $1 million, and with ancillary costs associated with that as well. So that really gives you the ability to drill some of those deeper holes, which are essential for understanding the system, and then also obviously chase holes that have smoke in them and potential, but maybe need to be refocused or retargeted, and so you can start drilling proper fences across a system as well to see what you've got. So it's an amazing cost advantage here in Kazakhstan, is that cost of drilling and the excellent drillers. The company that we're using now, AQS, I've got to know those guys very well, and through majors working in the country, they've adopted the standard safety protocols that you see in the West, and they're as good as anyone, and not as expensive.
And you are using a Western company to do the drilling, or are there even many options to pick a diamond drill contractor here?
Oh yeah. So no, it's all Kazakh owned and operated, and there are a lot of drilling companies and more coming every day. So we're actually seeing a lot of Turkish companies move in, and the Kazakhs themselves had quite a thriving industry, and now we're seeing Russian drill companies into the fray as Kazakh companies. But then the variation across the drilling community is big. But when we've now been here for 3.5 years, so I think we're starting to get our core sort of service providers, and they know what we want, we know what they want, and that just adds to the efficiency.
Okay, and $25 a meter for the assays is also interesting. Where are you sending it for assaying?
Yeah, so ALS have set up laboratories around the country, so mostly prep labs. They're in the process, so they can do fire assay in a town called Karaganda, which is a kind of legendary mining town in Kazakhstan. And I expect they'll have the ability to do full ICP probably in the next 6 to 12 months. Right now, they're sending samples off to Ireland for analysis. But
Okay.
your turnaround here is, depending 4 to 6 weeks to get your results back, which is actually pretty good.
Yeah, it is. It is good. That's what I'm saying. Even the ones that go to Ireland.
Yeah. So essentially, you send your Carraganda for us is 4 hours away. So we just send our samples by road. They get fire assayed, so we get gold and silver results quickly. And then they send pulps off to Ireland to have ICP completed.
And are you going to be asking for gold, copper, and silver, like the full suite?
Oh yeah.
Okay.
No, we do a 52 element suite actually.
Okay.
Geochemistry now is becoming a big deal because it obviously gives you your results, but it also the utility of is it now gives you alteration, rock type, and zonation of a deposit, which our guys are pretty good now at sort of identifying this.
But also arsenic, bismuth, cadmium, all the nasties, you're looking for them?
Oh, yeah.
Okay. Is there a risk of there being elevated levels of arsenic here at this system?
We don't know about Muskoka. Oh, sorry, the projects in Alamus. Thus far, we haven't seen it, but Muskoka certainly has elevated arsenic. And the reason why we've got that is we've got what they call a telescoped porphyry system, which has got an epithermal system basically overprinting the porphyry mineralization. And that's where you get the arsenic being introduced. But it's a double-edged sword because what that does for us is that gives us exceptional gold grades. We've got a porphyry with 0.5 gram gold, and the core of it is well over 1 gram gold. But you also get the arsenic, which you've got to deal with.
Yeah. Why I'm asking when we talk about elements about arsenic is because with the historic drilling that you re-assayed, the gold equivalent grade was lower than the gold alone. So it made me assume that there's penalties, or maybe that the silver and copper contents were so low that they were considered a penalty for the gold concentrate as well. What was that about?
That's a bit odd. I'm going to have to check that because that makes no sense.
Well, I found that weird as well, but I can actually just pull it up here on the website and see. So I'm looking at Bereska East BZ6. That's the whole ID. That's 281 meters of 0.5 gold, 0.08% copper, 0.9 silver, and the copper equivalent is 0.37, but the gold equivalent is 0.44, whereas the gold alone was 0.5. And so that's why I thought, what's happening? Are there penalties? Is there something I'm missing here?
I have to look at that. Is it the same interval? That's the other question, because usually what we do is we've got we've got a mineralized length, and then we've got maybe that if there's a higher grade portion, we break that out as sort of being identified as well. Look, it doesn't make sense if that's what you're saying. So yeah, I can take a look.
Well, I was trying to understand that. It is, yeah, it's just on the same line as far as I can understand. It continues with the other holes as well. I mean, we have hole 16 had 0.15 gold equivalent. 0.14 gold equivalent. Gold alone was 0.15. Then the next one, 0.27 gold only. Equivalent goes to 0.23. And so sometimes it drops, and sometimes the equivalent is higher with some of the other ones. But with the first three ones, the equivalent is actually lower than the gold alone. But okay, I mean, the main thing that I was wondering about here is there's no penalties that you're thinking of right now that might be, again, penalties to the final concentrate that would potentially come out of here.
Not yet.
Okay.
I mean, that's something we're obviously going to be assessing if that's the case or not.
Right. Okay. Fair enough. So when do you go? I think we brushed upon it, but when do you go drilling? And then 4 to 6 weeks later, you have results. When do you go drilling? When are the results coming out?
Yeah, so we've got one rig that's mobilizing to Tay right now. And so that'll be on site probably in the next day or so.
Hmm.
And then we expect maybe at least one or two holes to go into Tay, because this will be the first holes into the system. Let's see what it looks like. And then we've got another rig showing up in 3 weeks onto Alamis, and then depending, we might bring that rig up at Tay onto Alamis as well. I'd like to get the full 5,000 meter program completed. I think before the end of November, maybe going into December.
Do you want to complete the whole program and have the results out all at the same time, or are you going to do sort of a hole by hole approach?
Yeah, we tend to release results in batches, as the results come about, and I like to, just the way the drill program sort of usually manifests itself. You tend to go to one area and drill the planned holes there, and then you move to the second area. So, having a few holes kind of gives you context of what you're seeing.
Okay. So what's the drilling efficiency? How many meters are you getting per shift, or how many do you think you're going to get?
It varies, but I think 25 to 30 meters a shift is not unusual with these guys. Which, but again, the caveat there would just be the quality of the ground. If it's easy ground, these guys move quickly. If you're going through faults and altered soft rock, etc., then that tends to slow things down a little bit.
Are voids typical in this in these systems?
No. I think the biggest challenge is going to be clays, because you've got a big alteration system. You've got hard rock, and then clays, and then hard rock again as you go through the lithocaps.
Okay. Yeah. Well, that's good too, though, because you need that arbitration system to have the mineralization. It's kind of a blessing in disguise, a blessing and a curse, potential curse. So, I suppose I'm looking at. Yeah, go ahead.
It certainly lets you know you're in a big system. The art is then you've got to narrow down that big system to where the juice is.
Yeah. I was just looking at the calendar. So you want to have the drill at Alamis in 3 weeks. Let's call it mid-September. You do 30 meters. Oh, are you going to do one shift or two shifts?
No, we do two shifts.
Two shifts. So 60 meters a day is what you're going to drill. So, okay. In mid-September. So by the end of September, you're going to have drilled a reasonable meterage. So by the end of October, is that too early to expect results? End of October, beginning of November, you expect the first batch of results, or is that too early?
No, I think that's a realistic time frame.
Okay.
So assuming accounting for moves and the inevitable problems that drills often have, I think 11 to 1,200 meters core drilled a month is quite a reasonable amount per rig. So if we've got two of those, you could feasibly get that 5,000 meter program done in 3 months.
Yeah. Okay, so you get it done in 3 months. So you have it done by mid November. I suppose, yeah, as you said, end of November, you want to have it done, and then you have all the results. So you're going to have all the results out from Alamis by the end of the year. You're going to have all of it out, and you're going to know what the next steps are, basically.
Yeah,
Okay.
I think that's, again, depending on the backup of samples at the labs, you usually can't control that. But end of the year and early into 2025, if for the last batch of holes.
Okay. And then depending on that, you're basically gonna know when you're going to be targeting a resource for. Like it'd be too early for me, I suppose, to ask you when do you want to have a resource out here.
Oh, totally. I think this genuinely is the first pass program. I think that is going to assess the whole Beresky target and the Alamus license. And you got to remember, we've got a 14-kilometer long copper anomaly that runs parallel to Beresky. And Beresky's, almost 9 kilometers in length. And then we've got this bigger one about 5 kilometers to the southeast, and which we call Imendai. And so equally, we also want to be following that up this summer. Right now, we've got teams mapping it, and we'll also look to possibly do some IP on that, and then follow that up with the drill rig as well. A target-rich environment is what we're in here. So, one of the things I've learned over time is going into an area with the hope of hitting the one-shot wonder is usually a recipe for failure. And so I've found over time, you want to think long and hard about your drill holes, and possibly, especially if you can afford the meters, which we can, you put in proper fences, because in addition to obviously testing the system and the mineralization, you actually get to put together a reasonable understanding of the geology, and that only helps you plan your next line of drill holes to test the project. So, there'll be quite a bit of toing and froing amongst the team on putting together proper sections of geology to understand what we've got.
But at the same time, that also makes for very active news flow. I think over the next couple of months, definitely, 4, 5, 6 months from here on, you're gonna have much more news than what you've had previously. One of those parts is having mentioned Tay. You're currently drilling at Tay, also 5,000 meters, 100 holes. So not deep holes, it's KGK. As I mentioned, you're drilling through the colluvial. How's that going? What's happening there?
Yeah, so to explain what KGK is, it's effectively like the equivalent of RAB drilling, so rotary air blast drilling, except instead of using air, you're using water as your lift to bring the rock chips to the surface. I've never seen it anywhere else except here in Central Asia and Russia. But it's a fabulous way to explore undercover. So just to take a step back, the belt of rocks we're in is called the Boshakol-Chingis magmatic arc. And it's one of 3 porphyry belts in Kazakhstan. And the terrain is very subdued. You're in, it's basically like being in the prairies in Saskatchewan or Manitoba. It's very flat, wide open terrain, and there's not a lot of outcrop, and so it's quite hard for geologists to go out and just straight map. So it's the reason why we use soils, and soils are very good for doing 2 things. Is in areas where there's no overburden, we can sample the saprolite and the weathered rock and kind of get our typical geochem anomalies. But it also tells us where we've got buried bedrock. So, a lot of younger sands and gravels and everything else. And so that allows us to then bring in the KGK drilling and drill through that overburden and test the top of bedrock. It's a very cheap style of drilling. It costs us $16 a metre, and you can effectively drill something close to 250 metres a day. And so if you've got 40 metres of overburden, you can grid drill this thing and develop a very accurate geology map in a way that no one's been able to do up until now. And so I kind of actually like having a little bit of overburden, not too much. 10 to 15 is perfect, because it opens up a world of possibilities for a buried porphyry target that we've got a real shot of being the first group ever to find.
Yeah. Early days, though. I mean, I suppose I suppose this is a couple of steps behind what you're doing at LMS. When are you going to have the KGK results out?
I think the rig should be also arriving on site. Reason why I equivocate here is I think it arrived yesterday. So the diamond drill rig is targeting a very prominent chargeability high, but the wider area we're going to test with KGK. So I'd expect we can start having a view of what it looks like, probably in the next 6 weeks as well.
But I thought KGK was already happening on Tay, because you announced it on July 15th.
Yeah, we ended up moving that rig actually to another license on the tech ground, and okay. So then we've moved it back to Tay just now.
What would fine? Okay, so you have 6 weeks. Got it. What would success here? If you find what you just told me that you're looking for, what would that mean for your relationship with your neighbors? I mean, if they see you're getting success at Tay with a mine nearby, what is it, 30 kilometers? How likely is it that they're going to make a push for it, or be interested into it, or want to talk to you?
Yeah, so we completely surround what's called the Boshikol mine, which is owned by Kaz Minerals, which is Kazakhstan's largest private mining company. And they're copper miners, and they've got 2 very serious copper deposits. I think it puts them in the top 10 copper producers in the world. And so if we start having success at a project like Tay, which is just under 30 kilometers to the north of their Boshikol deposit, of course they should be interested. And we've got a very friendly relationship with them. They've said to us they've got a full medical set up on the mine site. If we ever need that, it's open to us to come down, and they've accommodated us with site tours to their project. So there are real synergies there. And at the same time, we also have our joint venture with Tech Resources, who have joint ventured a lot of the ground that we surround the Boshikol porphyry deposit with. So there's certainly big companies with means and ability to mine in the area. So if we make a discovery, and if it turns out to be significant, the potential suitors who could then take it forward to the mining stage are there and should be interested.
What I'm thinking, though, maybe I'm approaching this a bit cynically, but I'm thinking about whether there's room for shenanigans, if you will, or maybe to Yeah, I don't want to call it that, but just for the sake of this example, to bully you out of the region. And I'm really only thinking about this and looking at it from the lens of someone who grew up in a post-Soviet influenced country. I grew up in Bulgaria, so there are tricks in Bulgaria. Not saying that's the case for Kazakhstan. I'm mostly thinking about whether that's the case, but there are tools, if you will, that local companies can use against foreign investors, like drowning them in red tapes and government officials to demand bribes to expedite the process, and then send other government officials to confront the company about potential bribes. So that happens, unfortunately, in Bulgaria today. How much of that rings true for Kazakhstan as well? Is that even a risk?
Well, look, I think those kind of risks exist in every jurisdiction. I've had similar experiences like that in Mexico and in Canada, quite frankly. I guess you can only go on the past performance, and here's what I'll say there is we put a bunch of mineral exploration licenses that completely surrounded the Boshakol deposit. In some cases, those licenses were less than 500 meters from the pit. And the ground was open. We put the applications in. And, to my mind, if there was going to be any silliness, those would be the licenses that had experienced that. And we saw none of that. We got issued the licenses. We've been able to access the ground and do our work with no issue whatsoever. I'll also add, the Kazakhstan mining department. I've got to know the people in there very well, and I've found them nothing but helpful and responsive every time we've had a query or a question. So, it's one of the things, obviously, that we were nervous about when we entered the country. What is this going to be like? Are we, moving into a post-Soviet country that's obviously right beside Russia? I would say it's been the best jurisdiction I've worked in terms of applying for ground, getting it. All the applications are done online. They're all time-stamped. You get issued a license if the ground is open and you make the correct application. I will say applications here take a little bit of time to figure out. They're very specific in how things should be written and presented. But once you figure that out, I would say it's actually been a pleasure to apply for ground here.
What do you think? Just as you're saying this, I'm not going to push back on it too much because we've already been talking for over an hour. Maybe we should do a Kazakhstan focused episode because I think the jurisdiction is way misunderstood or not even paid attention to. But just to maybe also paint a broader picture, what's OPEX? What are operating expenses for that nearby mine? Do you know how much it costs them to produce a pound of copper?
Yeah. So if you take Boshakol, so you're looking at power costs 2.5 cents a kilowatt hour. Labor costs, I think labor costs are rising here, to be frank, but I guess that's to be expected everywhere. But labor costs for skilled labor is very reasonable. And, the number that sticks in my head from just talking to the guys at Kaz Minerals is their all-in mining cost is $1.20 a ton that they're mining. So, it's reflected in the EBITDA coming out of or the cash flow, coming out of the mine there at Boshakol. It's a 0.33 copper deposit, and it had over $1 billion of revenue, gross revenue coming out of that mine last year.
Hmm.
So, I would say that's making at least 30 to 50% profit.
That is cheap, and I'm only laughing with pain here in Belgium at 25 cents for energy costs, whereas you have, what did you say, 2.5? So I see you're finding it amusing. You're based in Kazakhstan, right?
I am. So
what's your monthly bill for electricity? Come on, you can taunt me a little bit more. Go ahead.
Well, so I paid, I think it was about $35 last month. My cell phone bill was $10. It's a taxi to the airport costs $8. The cost advantage of Kazakhstan is really exceptional.
It's not that bad in Western Europe. It's just you multiply everything by 10. That's kind of how you can think about it. Taxi to the airport, $96 last time. No, 96 euro. Well, so even worse, like $100 or whatever. So what I'll try to keep it moving here in the sake of time, although there is more to dig deeper on at both Tay and LMS, and people should go to the website, read more of this information. Your team, by the way, is also easily reached. So if anyone has questions, reach out, ask questions. I also wanted to get an update on Biscauga, though. You're due $15 million there next year if you want to own 100% of it. Not a small sum of money, but also not a deposit that you can just, wipe under the rug. What do you do about it?
Yeah, that's a very good question. So, when we look at the current resource that we've got, as you pointed out at the start of the show, it's just under 600,000 tons of contained copper, 3.5 million ounces of gold. So I know you're not meant to do this, but inferred and indicated combined, it's 200 million tons at basically 0.5 gram gold and just under 0.3 copper. We think this system is much bigger, and we've the current resource represents, I think, in terms of the mineralized trend, probably 20% of that mineralized trend. We've done a bunch of drilling along a northeast southwest trending corridor that's got mineralization for 4 kilometers. And the epiphany that we've had is that we don't think it's one porphyry. We think it's a series of thin pencil dikes that are coming up along a prominent structure. And the reason why I bring that up is individually you don't get ultra large deposits, but because they're all clustered in the same area, collectively combined, I think you're looking at a very big system there. So I give you that background. So we think the opportunity here is to try and get a partner in that buys into that story and is willing to spend the money to target the concept of probably 3 or 4 porphyry centers as opposed to just one big one, which is nice. It makes for an easy story, but I think we've done enough work to demonstrate this sort of multiple porphyry center approach, and I'd like to think there's a number of very good candidates who'd be interested in a project like that.
What would that deal look like? Or is it a tech-like deal where they get 75%, they pay for everything, you get a free carry, or like what would be of interest to you?
Yeah, I think something like that would make a lot of sense. It is going to be a project that requires a lot of drilling, and so I think you do need probably a major in there who's eyeing up an opportunity like this. And we've got a lot of very slick infrastructure in the area now. So we could quite comfortably run a program like that. So it wouldn't even require the major to spool up their own team. That this is something we'd quite comfortably run, which we're doing for tech right now on the projects we've got under an option to joint venture there.
Yeah. What's maybe you can give me an update while we're talking about this on tech as well, what they're doing, and more specifically what I'm thinking about. I know what they're doing this year. Right now, there's not too much happening. It's really after next year that things ramp up. But what's tech's end game here, though? I mean, is it really only about them pursuing this partnership, getting their 4 projects, moving on with those projects, or would the idea be for them to take you over completely and just be a new large player in Kazakhstan? What do you think they want?
Well, I think they've come over to the country, and they spent quite a long time, obviously looking at the geology, but also assessing this new mining law and understanding the implications of that. And I don't want to speak for them, but I think they very clearly made the decision that they wanted to be in Kazakhstan, and there are tech type targets that potentially exist here. So in terms of what they want to do with us, well, so we've got a joint venture with 1,700 square kilometres of ground. That's their first pass with us is to test that. But if I was them, I'd be watching very closely what happens with our drill program on Tay and Alamis, and with what we're doing with Muskoga as well. So would they be interested in taking us out? I think that's going to be results driven, and if they see something that makes them think there's their new copper mine there, why not? I'm listening. I never turn down an offer that I don't have.
Yeah, that's a good point. Kind of sounds like my dating experience too before I met my wife, but that's a different topic. How much G&A are you expecting for this year? I'm just trying to figure out how much money you spend between now and that potential future that we're talking about on with tech. So I'm kind of trying to follow up with all the expenses you're doing in the projects. What about G&A? What are you targeting?
Yeah, so for the rest of this year, I think we're averaging just over 100,000 a year in G&A. That kind of covers the Vancouver.
Is that a month? Because you said a year.
Oh, sorry, a month.
Yeah. Okay. I'd be happy with 100 a year, but don't get me wrong. But go ahead.
So that kind of covers Vancouver, and then me being over here. So extend that out. We're in August now, so it's probably going to represent probably 400,000 to 500,000 to the end of the year on G&A, and then our work program. I'd expect by the end of this year we've got major geophysics, soil sampling programs, mapping, and obviously KGK drilling and diamond drilling. Now this year we'll spend probably $2 million on exploration on Arras ground, and then another $2.5 million on the tech ground that we're exploring.
That $2.5 million is tech's money though, right?
That's right. Yes.
Okay, so you're spending what's the $2.5 million is what you're going to spend from your money. I assume you have around 5 million ish now because you raised, what did you do? 5.3. You had some cash before that, but so yeah, what do you have right now? 4.5, $5 million bucks?
Yeah, I think depends if you're talking Canadian dollars or real money. But kind of maybe 3.5 million US.
3.5 US. Okay. But you're not, well, the point of the G&A was because you're going to be more active this year, you don't expect to have a higher G&A, like you don't need more staff in
No,
office or something like that.
no.
Okay.
And it should be pointed out that half our G&A in country is covered by the tech joint venture as well.
Oh, so tech reimburses you they give you about 50 grand a month for
Yeah,
managing these things.
yeah,
Good. Oh, that's really good. So, well, your effective G&A out of pocket cost when all is said and done is 50, 60, 70 grand, not more.
that's right. Yeah.
Okay, good. So when all is said and done this year or next year, when do you go back to the market to look for cash? And more importantly, how much cash are you going to need for the next steps after the current ones?
Yeah, that's a good question. So, I think if we have success on these projects, and the beauty of a project like Bereski, is we've got a very clear soil anomaly. It's big, it's coherent, it's strong. We've got a very clear geophysics target, which is underway right now. But underpinning all of this is some historical drilling from the Soviet times that already speaks to pretty good mineralization in that particular target. So the reason that I bring that up is the two zones that have been drilled in the Bereski target are 5 kilometers apart. They both had ore grade mineralization starting at surface. I think you read out some of those results. So the question for us to really answer is what's in between that, within that 5 kilometer zone. And if we start getting similar results and similar numbers, that's a big area to drill out. So we will be needing to raise more capital as we roll into, let's call it the first half of 2025, if we intend to obviously chase it with the drill rig. Or, if we find the right partner and the right deal and they feel they must have this project, then, we're open to exploring that option as well.
Yeah. But, well, raising 15 would be the less preferable option, in my opinion. So especially because you have all that other ground that already offers upside potential. So that's something. Good. Why I'm asking is or what I'm thinking about here is how do you market that story as it is right now? Because if you have to raise capital, hopefully you're doing it at higher prices than what you are right now. So where do you go? How do you market the story? Who do you market it to? Because it is in Kazakhstan. So do you go east or, well, I suppose southeast and you go into Australia, or do you go north and you come to Europe, and then even more west from here you go to North America? Where do you market this?
Well, I'd say two things. So when Darren Klink, he's my partner and president of Arras, when we've been marketing the story, when we'd show up in Europe, we'd have 5 slides on Kazakhstan, and very quickly people would say, "Yeah, look, we know about Kazakhstan. Just get to the story." So we don't need to sell Kazakhstan in Europe. It's results driven. When we got to North America, however, we did have to spend a lot of time marketing Kazakhstan and explaining some of the key fundamental changes that had happened. The sea changes being we're now starting to find, even in North America, sort of Kazakhstan and its viability and what's actually going on here is filtering through. Your average broker and banker is starting to get up to speed on the jurisdiction. And I think to answer your question, the bulk of our last financing came out of North America. I would expect the same to occur, but it ceases to be, for us at least, a discussion about jurisdiction. That seems to be getting through to the market that this is a very good place to be, and it's just going to be based on the results of our drill program and exploration.
Who do you find more receptive to the story? Is it a European retail story? Is it an institutional story, but more like, who do you find more receptive to the story?
Initially, it was high net worth individual investors, but I think as particularly the copper market has changed, and people really are seeing a shortfall in copper on the horizon, we're starting to get a lot more institutional interest in the story. I will say, Sprott has been very receptive to it. They were one of the first investors into the Kazakhstan story, and as they should, they knew a lot about the jurisdiction straight off the bat.
Yeah. It makes sense when you're approaching more sophisticated investors in that way. But then in terms of budget, it was about 15% of your administrative spend during the last 6 months. Is that where you want to keep it, about 15%, or do you want to ramp up marketing here?
Yes and no. Darren and I talk about marketing a lot, and we very much like targeted marketing. A lot of conferences can be expensive, and you don't achieve a lot at those conferences. So for us, we've both got pretty good networks around the world. So setting up our own tours to go and visit investors, and then kind of key conferences, and then reaching out to guys like yourself. I think what you're doing is going to be the future. It's certainly one of the ways the new generation of investors, I think, are starting to find stories.
Maybe I'm a little bit biased, but I do agree with that. That's what I'm targeting as well. Almost an hour and a half that we've been talking. You promised me only an hour, so I've not been respectful of your time. I'll try and do a little bit of respect here. What am I forgetting to ask you here at the end, Tim? What should I be asking you that you haven't been asked?
Well, I think you've done a good job covering the story, and maybe I can give just a succinct summary of the opportunity. We feel we've landed in one of the last truly great unexplored regions of the world. You're not walking in blind. The Soviets actually did a lot of very good work, so you're able to take advantage of that. And we've selected effectively the most unloved porphyry belt in Kazakhstan. As I say, there's three porphyry belts. And I think the reason why the other two have received more attention is that the outcrop's better. They stick out of the ground, and they're more impressive, at least to walk over the top of. Where we are, it's a lot more subdued and not as spectacular on the ground until you start drilling. So we think we've got into a porphyry belt that really benefits from sort of modern exploration techniques with geophysics and soil sampling, etc. And we know it's productive. We know it's got viable porphyries. There's 3 known porphyries officially in this belt. 2 are in production, and we have the third with Muskogee. And then with our land package, we think we've got another 4 porphyry targets at least that really haven't seen the light of day. On half that package, Tech is our joint venture partner. On the other half, we retain 100%, which we're drilling this summer and going into the next year. And I think we're truly in a place that you can make genuine big discoveries at surface with a cost advantage, both in exploration and mining, that you don't see anywhere else on the planet.
That's a good summary right there. I hope you're right on that, right? There is risk involved and everything that we talked about today still applies, but I do hope you're right on that last part, because the market could really use some excitement. They can use some new exciting discoveries in a jurisdiction that nobody's paying attention to. And right about now would be a good time for that. So thank you for that overview, Tim. I know it is getting late in Kazakhstan, though. I've already not been respectful of your time. You only promised me 60 minutes. This has been over 70 minutes by now, probably. And I also already have someone else waiting for me in the Zoom. So I'll let you drop off now. Good luck over there. Thank you, and hopefully speak soon. And in the meantime, as Tim's dropping off, I'll be looking for gold once again by being in 2 spots at once, actually, with that being specifically Ontario and Wyoming in the US. So Ontario in Canada, Wyoming in the US, where I'll be getting help from Brian Skanderberg, the CEO of GFG Resources. Companies listed as GFG, surprisingly, on the TSX Ventures Exchange in Canada, where an average of about 100,000 shares trade each day, with a 52-week high of 12 cents and a 52-week low of 6.5 cents. With a market cap of $18 million and about 240 million shares outstanding. Today, this is a 7.5 cent stock. There are about 18 million warrants and 7.5 million options, leaving the number of fully diluted shares at about 238 million. According to the most recent presentation, and some of those warrants, by the way, have just been amended, so please read more about that in the company's June 28 news release. According to the most recent presentation, as I was saying, insiders here own about 6% of the company, and some of the other known names on the share registry are Alamos Gold, Delbrook Capital, Pathfinder, Probe Metals, and a few other relatively famous names are on the share registry that you can see on your screen right now. The last financial statement, which is dated March 31st, shows me about $750,000 in current assets, $600,000 of which was in cash at the time. $135,000 was prepaid expenses, and about $28,000 was in the form of a GST tax receivable. Although it is worth noting, though, that GFG has raised capital since, but they're also actively drilling, and as a non-revenue generating company, they typically spend money from the treasury to make that drilling happen. There's also been a deal for the sale of one of their assets, as I'll tell you about in a second. So that will also have amended the financial situation. There's no long-term debt that was recorded for the first quarter of the year, outside of the asset retirement obligations, of course, and a small lease liability that sat at about $25,000 at the time. Short-term obligations came in at about $500,000 in total, although that includes $100,000 worth of flow-through share premium. And the biggest part in the current liabilities is played by $300,000 worth of account payables and accrued liabilities. In terms of corporate expense, that same financial statement from the end of March covers the first 3 months of 2024 shows me that without counting share-based compensation and depreciations, GFG spent about $150,000 per month on average on what I would call administrative expenses, where investor relations represented about 28% of that. Another roughly 30% of that money was spent on salaries and benefits. Property holding costs were about 15%, and director fees in combination with professional fees made up about 10% of that overall spend, with various smaller amounts being spent on other stuff like regulatory, rents, insurance, and so on and so forth. You can read more about management compensation on note 15 in the company's financials or in the management information circular, which is, of course, available on setterplus.ca. Running the company is, of course, not the only thing they spend money on. As an exploration company, it is befitting for them to have an exploration and evaluation expense on the financial statements as well. And that exploration expense came in at about $260,000 per month on average for GFG, when averaged out over the last reported 9 months. 30% of that money was spent on salaries and benefits, a hair over 20% on consulting, another hair over 20% on drilling and geophysics. About 15% was general field expenses, and various other smaller costs like acquisition, staking costs were part of that exploration and evaluation expense as well. As to the administration to exploration ratio, with the information currently available to me, my calculator says that GFG spent about 37% of its money on administration and 63% of it on exploration and evaluation. And as always, please understand that this financial statement is nothing more than a snapshot in time. In this case, it is specifically at the end of March of this year, and it simply shows you that. It just shows you what the finances looked like on that exact date and nothing more. So I mentioned earlier, finances are a fluid thing, and I could be making mistakes in my reading of them. So by the time you're watching this, please head over to the company's website, as well as, again, setterplus.ca to look at all the numbers yourself and make sure you're getting the full picture. Now, for GFG, part of that full picture is what you might have thought is gold for gold, gold for gold, or gold for gold. Why not? But apparently it is gift from God. That's apparently where the name came from. And the focus for proving that this might indeed be a gift from God is close to Timmins, the Timmins Gold Camp in Ontario, a relatively famous gold camp, one of the most famous ones in Canada, really. GFG has 3 properties around Timmins. One of them is called Montclair, which is about 50 kilometers to the east of Timmins, and it's actually split into 2 projects. Both are associated with east-northeast trending fault zones, provided that they're situated north and south of the Pipestone Deformation Zone, which is the reason why I'm telling you this, besides wanting to appear smarter than I am, is because it is an important structural feature for the region. We might talk about it later on. Then we can move on to the southwest from Montclair, again, about 50 kilometers southwest from the town of Timmins, Ontario. And that's where we'll find a much larger property that GFG owns, and it goes by the name Penn, or Penn Gold. Penn Gold covers about 475 square kilometers of land, a portion of which is part of the Archean greenstone in the region, and it's also housing similar lithologies to some of the deposits in the Timmins Gold Camp. And if we kept going south from here, we'd stop by onto a smaller but not small property. It's called Doré Gold, which is it is half the size of Penn Gold, but Penn Gold is a large property. So this one is still large at about 212 square kilometers, covering 12 kilometers of the Archean greenstone here, although these 2 assets are not, or have not at least, been the focus for the company over the recent past. And about 30% of the exploration budget this year is expected to go into these 2 assets combined. That is 30% of what the company estimates to be a $2.6 or $2.65 million budget, to be specific, this year. More about what that money will be spent on exactly later on in the conversation. Ontario is not the only place GFG operates or used to operate in. They also have or had an asset in Wyoming. It is fittingly called Rattlesnake Hills, surely not because there are a lot of rattlesnakes in Wyoming or on this hill. Again, not a focus for the company at all. There is also a lot of historical work done on this asset, including Newcrest as of most recently, who decided to step away from the option to acquire this asset a couple of years ago. But GFG also drilled it themselves before that, didn't find anything that they liked, didn't want to follow it up on it. So since then, they've signed a definitive sales agreement with another company, which will result in about $1.7 million of cash payments on the date of closing, by the date of closing, really, and also 3 million shares valued at about $600,000. And an additional $1 million is to be paid out to GFG 12 months after the closing of the sale, if I'm reading the news release correctly. So plenty to talk about here already, Brian, but this is your first time on the CEO Barbecue, so obligatory questions are in order, starting with a fan favorite, least favorite for CEOs, as always. And when I say fans, I really only mean my mom. But why should I trust you with my money? What have you done in your career that proves to me that you're to be trusted?
No, look, thanks, Antonio, for the invite. And for myself, trust is absolutely critical, whether I think about team at GFG and I think about our shareholders and stakeholders. And so when I go into trust, I think about my history. I grew up on a small farm in Manitoba, very much rural feel. But when I think about GFG and what I've done lately, or to answer your question, the history of myself and my career is running an operator called Flood Resources. That was a really good learning curve earlier in my career, where I joined them. I was with them for 10 years, moved through roles from VPX to COO to CEO. found a nice ore body, one of the largest gold ore bodies in Saskatchewan, and it ended up going into production. And we were good enough and lucky enough to sell it through a fairly significant transaction to SSR Mining, and most of our stakeholders did exceptionally well out of that deal. So strong history in production and exploration. Prior to running Claude, worked for a couple of juniors in Africa. I've worked for Goldcorp. I worked for Inco. These are big companies based in North America. So I think it's important to have people that have both a junior and senior mentality in their career paths. We founded GFG 7 years ago. We took it public. It's been a slog. I don't think the junior space is. It's certainly been a battle these last times, but we've survived. We've done some really good work. We've found some new ore bodies and systems and Timmins. And I think we're on the edge of doing something really great in Timmins these days. So, to me, trust and is career paths. So look back at what I've done in my past. We've had success at exploration. We've had success at monetizing and transaction into building shareholder value with Claude. And I think we're showing a good track record of finding new gold systems in a really exciting camp in Timmins. So that's a bit around the trust side. Our management at GFG is very transparent. So any shareholder that wants to pick up the phone and call us, more than happy to have those conversations. Most of our shareholders, even have my mobile cell number. So look, there's a lot of relationship building in this company, and a shareholder needs to feel like they can call me anytime and get the answers they want. And I think that really passes on this trust piece to stakeholders.
Who picks up the phone if I call the phone number that's on the website? Who's going to pick it up?
So you'll get either Mark LePage or myself. You might get Marilyn McLeod, who's our office manager, and you can quickly go to either one of us through the directory. That's our main office line. So we put those lines on all our press releases, and pretty easy to get to. And I think that's really critical for juniors, building the relationship with your stakeholders. They need to feel like they can call us. The exploration business and mining business, a lot of highs and lows, lots of technical details, and we can't often pass many of those into a press release. So logically, there's things that need to be discussed in more detail, and we really try to make ourselves available. And even webinars like this or some other ones we do are very useful platforms for conveying detailed data and analysis.
Is it not Marc Lepage, as in French?
Lepage, Marc Lepage, yes.
I'm sure he's gonna enjoy. I'm sure he enjoys you calling him LePage all day long. What are the three? I get it. So you have some success under your belt. Fair enough. As everyone likes talking about success. What are the three last companies you were involved with, and what are some stuff that could have gone better? Everyone has those as well.
Obviously, GFG has been my home for 6 or 7 years, and been a battle, as I said. Prior to that, I was running Claude, 10 years at Claude, and a lot of different roles. Mark and I joke about there being 8 tough years and two good years with Claude, and I think that's reflective of the space. Things that could have done better. Look, exploration and mining is a risk business. You go out there and you test your targets. You do your best you can to prioritize them and advance them. Sometimes I think we could have done the timing better at Claude in terms of finding things earlier and quicker in our path. It's always difficult with a cyclical sector that we have. Prior to Claude, I worked for a company in Africa called Helio Resources, and that was wandering around Tanzania and Namibia looking at grassroots exploration in the southern Tanzania or northern Namibia. So that was a really interesting one of living and learning the African exploration model. I did study in South Africa and did masters in mineral exploration, so I was quite familiar with a lot of the systems there. And it was a great learning experience and different than what we would have here. The other company I'm involved with at the board level is Wesdome Gold Mines, a couple $1 billion producer in Quebec and Ontario. So I've sat on that board for 4 or 5 years, and one of the technical members of the board of directors. So those would be the 3 or 4 companies I'm intimately involved with: GFG, Claude, Helio, and Wesdome at that front. Try not to spread myself too thin. I think people get overboarded, stretched technically, So my focus needs to be GFG, and if I'm involved with any other company, I'll limit that to one at the board of directors level. I don't want to sit on 5 or 6 boards, and just don't have the time really to focus elsewhere. So cognizant of that front. You know, in GFG, lessons learned. Look, I mean, we're selling Rattlesnake for $3.5 million. You know, we started this company with that asset. So, you know, do I think we could have, in hindsight, looked for a different assets right off the start? Sure. You know, live and learn. We started this company. It was a shell. It was a private company. All it owned was the Rattlesnake asset. We explored it for about a year and a half. We found it wasn't really our bag of tricks, cup of tea, and we really wanted to pivot back to the Shield in Canada, the Abitibi, which is where we've ended up. But nonetheless, that's time, money, shareholder value in an earlier stage of the company, which could have happened quicker. So, you know, lesson learned. Maybe on a filter going into you know, a jurisdiction in the U.S., higher cost of exploration, different types of systems, probably some intricacies maybe at Rattlesnake that maybe work for us. But yeah, live and learn. And if there's anything I've learned in sort of 20 years of this business, we're all learning as we move through our career. And what we need to do is reflect back and what we can do better, what we can do quicker, what we can do more efficiently. And we're always doing that within GFG.
There's another thing that can make it easier to trust that you've learned from those mistakes, and that's if you trust yourself, of course. So, well, I suppose, do you? I mean, do you trust yourself with your and your family's money? And what I'm trying to understand here is really how important is GFG as an investment to you? Management insider ownership, again, about 6%, as I mentioned, I believe last I checked on the presentation. So, yeah, how much of your own money have you put into this company? How important is this investment to you?
Yeah, critical. I mean, it's financially relevant in my background, and it's professionally relevant in the sense as CEO, you stake your name, your reputation, and your path on the company you're with. So in both of those fronts, it's very critical. It would be my singular largest holding of any company, personally. And I can tell you my cost base is probably around 24 cents on the name of the company. And much of that was bought earlier on history at 25 cents US, which is what we raised at when we set this company up. So what I can say is that the current management of this company isn't a founding shareholder in the sense we don't have penny stock, we don't even have 5-cent stock. You know, although I do believe I think I bought at the lowest price in the market, which was at 1.65 cents. I think I was the one that acquired that stock just in the free trading market. So continue to support it as I can. It's specifically a relevant chunk of my background and my financial wherewithal. It's risk capital. So like any prudent investor, it needs to be balanced. And I do view this portion of the sector where your management, you have your professional stake on the line, and you also have a fair bit of financial stake. You know, it's appropriate to balance it as any true prudent portfolio manager does.
I did see in the SEDI filings, there's a filing from the 23rd of April filing date. And so that was done on the 19th of April. It was done under so acquisition under a prospectus exemption. So you bought $272,000, but 8.5 cents, and then $20,000 worth of stock at 10 cents. So this is under the prospectus exemption again. I suppose is what you just brushed upon. Any plans to keep buying in the market? I mean, is it sitting in and around this price? Actually, as we're talking, your stock is up, so congratulations on that. But any plans to start buying again around that 6, 7, 8 cent range?
Look, I'll always support it at the appropriate times when I'm not in blackout. You know, happy to see the stock trade more strongly on the release today. When you go back to that SEDI filing, there was 2 filings, and you know, full transparency, one of those was a cross into our largest shareholder in the United States. So, you know, the legended stock sometimes is a challenge to deal with for US investors. And so in that sense, you could look, and I've disclosed both a sale and a purchase under SEDI. One of those was a sale to a shareholder, and one of those was a purchase through the financing. So that's kind of a wash, but it was certainly a benefit to the shareholder in the sense that he didn't have to deal with trying to remove a legend out of US stock. Yeah.
Yeah, no, I can see that. That was before. It is indeed related to your March 28 purchase and sale. Got it. Good. Do you have any other incentives in place, like anything else that might cloud your judgment? A royalty on the projects, your family, a service company that's currently delivering services to GFG, something else?
We keep it simple. You know, I tend to find opaque transactions like that not necessarily in the interest of shareholders nor management. You know, there's always opportunity in this industry to do things personally or through a private corporate and roll it into another company. That's not our style. You know, so we'll do things very much above board. If somebody brought us an opportunity, there's no way I would ever doing something personally. It would all be through GFG. So there's no consulting company or private interests or anything of the sort related to myself or management in general, any of our management.
Good. No royalties, no. Well, service companies can be fine if you manage it properly, but I prefer them that there not be anything to manage. I guess that's easier.
And just for clarity, I mean, there's various royalties on part of our properties, but none of those are held by ours, right? So you're just looking for conflicts of interest here. That was the question.
Yes, sir. Yeah, so none of them are to your personal name or your family's name. That's important to me. Good. But understanding what kind of person I'm talking to is important, or so I've been told, but it's not everything. Of course, the right people have to be working on the right opportunities and at the right time too, I suppose. That kind of leads me to a question of, do you think this is the right time in the market to be approaching what you call a district scale opportunity? Like, will the market care about it even if everything went as planned to you?
That's a good question. I think when you look at it as an investor and even internally from a management's landscape view, after 7 years, we might ask ourselves, you know, are we doing the right thing at the right time in this sector? And I will admit that even management sometimes questions that, in the sense that you might have a discovery, you might have exploration success, and you might not see it translate to valuation and shareholder return. And I think that's a valid question management should ask themselves all the time. But when we look at where we sit today, and I was doing a presentation a couple months back to a retail audience that, you know, not a sophisticated gold investor landscape, and I just threw up 5 charts. One of those charts was just metal versus equities, and it's the biggest gap you'll ever find between how equities are trading and the price of the metal. Now, there's lots of reasons for that, but that's a simplistic chart that portrays the opportunity that exists between where the price of gold is and where gold equities are trading. And at the exploration, at the high risk end of the space, we tend to play at even a larger discount than, say, some of the producers. But what I'm optimistic about is that at this time in the landscape, there's a lot of free cash flow being made in the industry. There's not a lot of companies investing in at the bottom end or the front end of the cycle. So the pipeline's drying up. And when you look at each piece of the M&A that's being done and completed these days, and you can go look at a Cisco back a couple days ago, you can look at some of these other investment landscapes. Those are development projects being acquired by producers, and they're showing what the gap exists. Now, I think over time, we're going to see that gap be closed. It's at an all-time high, and by that I mean the valuation gap between where explorers trade and a general producer, and it's going to be closed if the retail market or if the institutional investor market doesn't close it. The corporate market will close it, and by that close the gap by acquiring things. So that's where I think the timing's good. Metal prices is an all-time high. The gap between explorers and producers is as high as ever. And the number of groups of teams doing very quality front-end work is very limited. So those that have success will get rewarded. You can look at the Snowlines of the world. You can go look at, you know, the Cisco, which worked for 7 years to take that project forward and then sold it for 2.2 billion. So I think timing is very good to look at this piece of the space.
There's the number of companies on the exchange is at an all-time high. The number of teams that know what to do with those companies is at an all-time low. That's not my quote. Would have been cool if it was mine, though. But someone else told me that, and I do kind of agree with that. What else? What then do you think the market wants to see over the short run, though? Because again, your share price, even though it went up as we're speaking with this most recent news release, what is it, 14 grams over 7 meters, give or take.
Yeah.
It's still down quite a lot from its high of almost $2 in 2016. That was the other project. But even more recently, when you look at a 1-year chart and 2-year chart, so it's still down. So what can you do to move the needle for the market in the meantime, as you're working on what, again, you call a district scale opportunity?
Momentum, continuous news flow of relevant results. And I do think that that's the biggest piece. You need to translate a given result, like for 13 grams over 7 meters, and show that it's meaningful, show that you can follow it up, show that you can deliver scale on it, and you will continually be rewarded. So you're absolutely right that a 20% bump on a 15 million, 17 million market cap company has only added $3 or $4 million of market cap. Relevant discoveries should be getting 50 and 80 million of value unlocked if they're a relevant discovery. And I think that benchmark is held pretty good over like last 5 to 10 years, where you're looking at just announcement of a very relevant drill hole discovery. So I think from GFG's perspective, we need to continue to put good results to market and show them that something like Aljo has scale, and we need to continue to deliver on the other portions of the pipeline. And by that I mean it's almost like the non-sexy portion of exploration work, which is, you know, the front end of targeting. But you know, later in this call, we're happy to talk to you about something like Muskego, and there's a front end target that can very much move the needle of the next relevant discovery that we're building towards first drilling in the next 6 months. And so I'm really keen to continue showing momentum at Aljo of quality, high grade, shallow drill intercepts that can move the needle, and continuing to build the other pipeline. And none of it matters if we're not going to get on, you know, be present in the market, you know, engage with guys like yourselves and do a proper job of marketing the story. So we need to cover both ends of that to be relevant.
I suppose saying district scale is kind of an eye catcher here, and a little marketing is fine. I like a little marketing, of course, when it's done tastefully, but nobody finds it and defines a district scale project kind of in one go, right? It's a process. And where in that process can you operate in this year to keep creating that momentum? What's the main unanswered question, if you will, this year? Are you focusing on grade, continuity, expanding the scale, something else entirely?
Several pieces to that. I think you have to look at it in an individual target scale. And when it comes to something like Aljo's, which we published drill releases on this morning, we can put 2 or 3 drill results, like press releases out that show that thing has scale, continuity, growth, stacked veins, high grade. That's something I want to do this year. You know, if we can show advancement towards drill targeting and get Muskego, which is one of our other relevant targets, to a quality drill ready stage where, you know, where the market might understand the size of the prize. And then there's also another target called Montclair, which is where we spent much of our work the last couple of years, and we're doing metallurgical work on it right now. So that's an area where we have an interesting deposit. It's getting to be some interesting size. We need to de-risk it by understanding the metallurgical portion to it. So if you looked at our corporate objectives, I've probably touched base on 3 of the 4 right there, and the 4th one would be Rattlesnake. So go back and measure what we're trying to do this year. Grow Aljo, show a relevant discovery, figure out if Montclair has any legs underneath it from a metallurgical standpoint, build the pipeline with things like Muskego, and find the right home for Rattlesnake, which is what we've done. So that's how I go back and think about our objectives and convey what's achievable this year.
Aljo and Montclair, too, the majority of stuff in Ontario, right, have been looked at before. What do you think the previous operators missed, or what did they do wrong that they couldn't get the same results as what you're after here?
Timing is one thing. Timing with respect to gold price, timing with respect to evolution of the camp. And by that, I mean sequential development and availability of mills, and the need for satellite feed. So when you think about Timmins has evolved to be a camp where there's now 4 or 5 mills that can realistically look for satellite feed. And winding you back to maybe in the 90s, when anybody last drilled Aljo, kind of a different feeling in 91. Going back now, it's almost 30 years ago. So the camp dynamics very different, the gold price very different, the need for feed by satellite feed model very different in the camp. So those are the ones that are maybe more sector related. And then I look about it internally, and I'm like, look, you always need to think about the team and the detailed geological understanding. And I could use Montclair as an example where most of the drilling was done, prospector type IEP, good group, but probably not going to take it all the way to the resource and build things out. And that's who we acquired it from. Our structural understanding would be very superior. We've drilled some much deeper holes. We've had better results. I think we understand the ore body better. Aljo, same type of example where, the detailed geology work of understanding these vein orientations, how you drill them, what the controls are, the relationship with the porphyry diking, all very key to understanding the system. And then something like, Muskego, where people avoided hard things because they're not simple, easy, or efficient. And exploring under a big swamp, it's not easy, but it's actually where the opportunity is preserved at the shallowest level. So looking under areas like that, if you took a prospectivity filter over the whole Abitibi, those are the areas that are glowing red because they haven't really even seen that first pass of exploration. And Muskego is an example like that where we're drilling a sampling till and we're hitting visible gold in the bottom of the till hole underneath the swamp where there's not an outcrop within 4 kilometers of it. And those are the types of things that we're doing differently than maybe historical operators would have.
The higher grades that you've just reported from Aljo, they seem to be related to the visible gold. It's kind of like there's visible gold, there's high grade. Obviously they're related, but that's what I mean when I say related. But that also, the visible gold kind of occurs in isolated pockets. Has that been a problem before? And do you think you might have challenges with the continuity of the mineralization here?
Two things. I mean, nugget effect's always a challenge in most gold systems. And the nugget effect is just basically like the sampling bias you have from coarse gold to fine gold. 100 grams in one sample, 0 next to it, right? So the one thing I'm happy about with the Aljo system is, where you're seeing visible gold, yeah, you get a good spike of gold, but you actually have some shoulders to it. You have some other fine gold associated with it. You have sulfides there. I don't personally think the nugget effect in terms of continuity of given assay in a given vein is actually that high at Aljo. There's actually lots of fine gold with it. This understanding of the structure is most key there, and understanding there's both northeast and northwest oriented veins, and you have to understand where you're drilling those, what your target is, how they relate, and how do we model those. So I'm actually quite happy that the nugget effect at Aljo is more than manageable, and where we need to focus more of our time is actually building the structural model that embeds vein orientations with the other controlling geological features that drive that system.
Talk to me more about that. Talk to me about the structural controls here, because I was under the impression that you already have a good understanding of how they work, but now maybe there's an element of not complication, but a little bit more complexity at least.
Yeah, I think gold systems inherently maybe get a little more complex as you drill them most of the time. Now, with respect to Aljo, there's 2 main predominant vein orientations that control the gold and the mineralization. And there's a genetic relationship, or at least a spatial association with these porphyry diking, and that is common in much of Timmins. And then there's the through-going area in certain shear zones that are also probably fluid conduits. So understanding the relationship between these 2 main vein orientations with your porphyry diking, with the shear geometry is the piece. So I think we have a reasonable understanding of the controlling features that are driving gold mineralization there. And we'll always improve with that as we get more drilling data. One of the things we do a fair bit oriented core. So if we drill a vein, we can actually understand is it azimuth 220 and dipping at 70 by measuring that core. And that's a really critical piece to understanding gold systems is doing that core structural work on the core to get the detailed orientation. So more to learn, but pretty happy with the progress that the team has made so far.
Do you think there's value or could be value potentially in chasing footwall mineralization here?
You know, out of all the mines I've worked in or seen, and I think at last count it was probably 150 mines or gold systems I've looked at, you know, almost like a huge number of them have main vein, hanging wall vein, footwall vein, and they number them all. And it is amazing how many of these systems we'll look at, and you'll come across a historic deposit, and there might be a showing or a mine there, like Alto, and it'll have a mine that's been developed and maybe produced 20, 50, 100 million ounces of gold. But yet how immature from an exploration point of view, either a hanging wall or often the footwall may be. And so footwalls are interesting because most of your drill holes come from the hanging wall, they hit the ore body, and you stop drilling. And sometimes you push holes deeper into the footwall. But, you know, the rationale and the time investment of money to test that footwall is often not, you know, considered all the time from an exploration or development point of view. So footwall environments are often one of the most fertile areas to find new veins. So as an explorationist, I'm always looking at a mine and saying, what are the controlling features? How do they impact the footwall? How do they impact the hanging wall? Where is the prospectivity around this mine highest? And I don't think it's a fluke that in Aljo you can find us drilling materially invisible gold-bearing samples and good veins in the footwall.
What does the name mean, by the way, Aljo? I tried looking it up. I couldn't find anything.
You know, that's a good question. It's not a township. It's not a First Nation name. It's not a name of a lake there. And it is a name that goes back quite a history, but I've never really had it explained to me in any report that I did. But I will find that out. I've looked for it before, but I've never managed to find an adequate answer.
That's not important. I'm just being nerdy about. I like languages, and so I can be nerdy about that. Not important.
Yeah.
What is important is Alamo's stake in GFG. Does that have or will it have any influence on how you explore Gold Darn as a whole? I believe they have land close to it. Or are they talking to you and saying, no, you know, don't drill below the historic workings, go to that new target or something like that?
Look, I mean, Alamos is a very savvy investor and explorer and miner in the gold space, and their track record of success, both from an acquisition and discovery point of view, is very high. So, you know, they invested us back when we were exploring in Penn, and like some of the work we were doing and like the prospectivity of the region at Penn. And they sat on the sidelines a little bit when we stepped over to Montclair and Gold Arm, and then subsequently they've topped their position back up and are quite enthusiastic about Aljo. We have a very strong relationship with our technical group. They're engaged in the targeting and the results in terms of how we're approaching and ranking our targets and moving them forward. We use them as much as we can in terms of a sounding board for some technical ideas, and they're very supportive. So I think one of the things you want to find, you know, and you'll find it with Alamos, is that, you know, there needs to be a level of trust and belief in the technical team. And I think Alamos has a good feel for us and belief in our approach and strategy and putting dollars to work in the ground. So they're very engaged. We're very open with them, and the relationship's super strong. We're happy to have them as a shareholder. They do own ground around us, south and east of Gold Arm, and they obviously have larger production facilities at both Young-Davidson and the Island Gold Mine, which are, you know, not that far away from us in terms of main infrastructure pieces, both at Pandora and Gold Arm as well.
Well, I do get them being engaged as a large shareholder. I can be engaged. That's what I call myself, being annoying, actually, to companies that I own maybe 1/100% or something like that. And so I get them being engaged, but I'm wondering how influential they are on your decision-making process specifically. And why I'm asking this, because I'm wondering specifically about deeper drilling, like it, given that it'd be more expensive, right? So they might want you to drill deeper, but is it prudent for your shareholders, for GFG's shareholders, for you to go and chase this deeper? Is now the right time? Do they want that? So that and who has the final word? Like who has the, not the final word, but who's got a lot of influence on this? It's kind of among the lines of what I'm thinking.
The finality of it is they're not represented within a technical committee of the relationship. So in terms of a veto or ability to formally drive the end decision of an exploration game, it's solely within GFG. That said, they're our largest shareholder. And, you know, they're a very valuable and technical savvy shareholder. We've been very aligned on the program so far. I don't think there's been a single incidents where we didn't have good, strong technical alignment in the approach and philosophy to drilling. You know, in the end, the decisions with GFG, do we absolutely respect and want the input of Alamos? Absolutely.
The and that's what the drilling, I suppose it applies to other stuff as well within the company, but you're probably going to have to do some more met work. You said you're doing met work on Montclarg. Are you going to be, the why I'm asking this is because the gold at Aljo is related to tellurites. Could that potentially be a challenge? And are you doing any met work this year as well to figure out what that's going to look like?
The telluride side of met can be an issue. That being said, every time we see a telluride, which is a soft gray mineral, and it can be a gold, tellurium, bismuth combination alloy, it has a strong association with visible gold. And so the presence of visible gold, very good, right? And we see a lot of that present. So I actually don't think that just looking at the mineralogy and the relationship, the character of the minerals, mineralization, that's going to be much of an issue. Haven't we advanced any to date on Aljo? No. You know, probably something we would look more towards next year if we feel optimistic about the direction of things.
Well, I'm not a geo, not a metallurgist, so you could have lied to me and I wouldn't have known, but I did see it in there and I thought I'd ask. But I appreciate you not lying to me. What other targets are you going to be getting to? I believe you, in the news release, you mentioned, what, 4,000 meters are left to be drilled. Where is that? How is that going to be split between what you've found here and all the other targets?
Yeah, I mean, priority will be Aljo. I think there's lots of scope to go back and do some more drilling directly in this mine or in the larger footprint, the land position. There's potential to go back and do some further work at Montclair. There's certainly one or two targets on the Gold Arm property that are interesting as well. So if I had to rank them in terms of how they sit within our priority matrix, you've got Aljo at the top from a meterage perspective. You would have Montclair down there further. As you look at the other portfolio, and this is where the 30% of the budget going to Doré and Penn becomes relevant, I do think that there's a reasonable probability that we get a target at Doré and a target, namely Muskego, drill ready. And I'd love to see us get some meterage into that H2 of this year. And the reason I feel like that is that it is a balance of the exploration budget all the time. But what I want to, and I think is appropriate to do, is balance some of your first pass. You know, this is the first test at this target. It's never seen a drill hole. And you need to be putting, you know, 20%, 30% of your meters into things like that. And I think an exploration company really needs to prioritize that, build your pipeline, turn it over, learn more about your first phase targets, because something like Muskego may blow everything else out of the water that we have from a relevance point of view and turn into a great deposit. And we need to ensure we give it this first pass drilling. So we're working hard to see if we can get Muskego and Doré into the meterage yet this year as well.
Okay, but the corporate strategy around drilling remains that, like, you want to drill the different targets. You're not going to be rushing toward an MRE or a resource at some of these targets or Aljo.
No, I mean, if you ask me what I like, what balance I like, take 70% of your meters and put it towards something where you're confident that you're growing a resource. You take 30% of your meters and say, I'm testing first pass things that are earlier stage discovery potential. And you know, it's not always bouncing around that, but it might be 25-75, it might be 80-20, but it's in that ratio. And that's generally where we try to head.
Right. Okay. How's money right now after the deal you've done with, or almost done with Patriot?
Yeah, look, last Friday we put out the definitive agreement. That was important for several phases. We had a binding LOI. They'd made a deposit of $250,000 with us, and they made subsequent commitments to make us cash payments and cover operating costs under that LOI. There was always a mutual agreement to advance towards definitive agreement and subsequent closing. The hurdle they had to get over was a shareholder vote, and they had the vote on August 9th. And we subsequently put out the press release, which was the advancement to definitive agreement. That is critical from a balance sheet perspective. So we raised back in Q1 the 2.7 million, 2.8. It was right in that range, and that was a good top up to the balance sheet. You layer that in with the 3.3 million sale of Rattlesnake, and it's not all up front, but you can take $500,000 of that, plus the 1.2 million. So you get 1.7 million in cash coming in by the time we close this deal in Q4. And that should give us a good position moving into 2024, where we also have another $1 million payment coming later, a deferred cash payment on Rattlesnake. The other couple pieces that are relevant is that on transaction, Rattlesnake, we do recoup back our bond. So there's a reclamation bond in the US, which is about $220,000. So on the sale of that, we would have a bond refunded back to GFG, run it through a relatively weak Canadian dollar, and that puts us in a good position to continue shoring up the balance sheet. So that should occur in Q4. So there's a couple pieces there, and then the equity piece, $600,000 in X cap equity, which would be also granted on closing subsequent to graduated vesting over the next year and a half. So this balance sheet's looking reasonably well right now. Like you started off, and I think you're very valid to say, look, exploration companies need to raise money. This company is one of those. We'll obviously want to keep active and keep momentum. Balance sheet's okay. Targeting our next raise, I'm optimistic this is a 2025 H1 timing.
So, well, essentially, to sum up what you're saying here is you have money to deliver an answer to that unanswered question, those unanswered questions that we've been talking about so far. You don't have to raise capital before we have an answer to a couple of those questions.
Yeah, exactly.
Okay.
Exactly.
Well, making big discoveries, Brian, is which based on your presentation is what you're aspiring to do here, is never cheap, right? Unless you get lucky, I suppose. But then let's then say that it's almost never cheap, I suppose. Talk to me about your overall strategy on financings. How are you going to keep financing the company in the future after this? As in, will it be only equity, maybe asset level dilution, getting a partner? That's famous in the Timmins camp for sure. That, I mean, it hasn't happened to you yet, or is it going to happen? Talk to me about strategically how we approach financing.
Yeah, you look at our history. We generally raise $3-4 million a year, and that's what we've done for the bulk of our history. And that's generally reflective of the level of corporate burn that we've had. Your number on G&A was close. It's about 1.2-1.3 million per year. And if we could spend 3 million in the ground, it gives you like that 75-25. Your ratio is like 65-35, which is a little softer this year. In terms of financing and strategic path in Timmins and availability of partnerships, those are always things we're looking at, and we've had lots of good dialogue on. With properties the size of Penn and Doré, the appetite to partner those, or maybe the strategic rationale to partner those, is valid. And we do have good dialogue. We've had some approaches historically. We even have current ongoing dialogue now. And I think as a target, as a property evolves in its understanding, management's constantly looking at the payback for investing in that property. Is the payback better by retaining 30% in a 70-30 JV under a conventional option, or is the payback better by exploring it ourselves? And this is something we're always asking ourselves. So definitely open and always looking at partnership opportunities in the Timmins area. Or even, in the case of Rattlesnake, we moved the asset completely. We said, look, we're better vested to move this. and participate in any success either via equity, cash, or an underlying milestone payment, which exists at Rattlesnake should they have some success down the line and made a big discovery. The piece I would also say is, when being big landholders in this colloquial district scale explorer, the trade-off is we control 800 square kilometers of ground. That's second only to Newmont in this camp, but it's a huge land position. So we have to make sure we can keep advancing all of that land position. And if we reach a point where we feel like, look, we have too much in terms of can we logically finance this initiative in this market, maybe we'd ask ourselves and want to partner some of those. So yeah, I mean, open to partnerships. I think it's valid to look at that as a path. And I think in many ways, some companies have done exceptionally well with partnerships. And I mean, you can use Orion up in Finland. The B2 joint venture has been a great way for them to explore, retain interest, still have some control, keep momentum moving. I think there's lots of great examples of partnerships being very beneficial to the vending junior.
Dave is definitely doing interesting stuff with Orion. I'm looking forward to the day where he can finally come in front of the camera and talk about whatever's been happening there, because it is definitely interesting. That time is not now, unfortunately, though. But yes, you're right. Partnerships, so asset level dilution, as they call it, can be beneficial. Some percentage of something is better than all the percentages of nothing, I suppose. And in your case, what I'm getting out of this is that basically it is more likely to see assets out, cash in, not completely out, but maybe partially assets out, cash in, versus, I mean, that's more likely to happen than cash out, assets in, meaning you're more likely to get in a partner than go out and seek a new project. Am I getting that correctly?
Yeah, you would. That being said, do we constantly look at other assets that would fit within our portfolio, our window, our bandwidth? Yes. Are there other things within the Prater Timmins landscape that are attractive to us? Absolutely. And we wouldn't be doing our job if we weren't looking and trying and talking and evaluating those opportunities that are out there. Probability basis, I think your statement's correct. Do we still look? Absolutely.
Warrants, part of financing as well. You just did a repricing of warrants, as I mentioned there. Not a fan favorite. People don't like repricing of warrants. What's up with that?
Yeah, look, we wore that one a little bit. And I can understand both sides to this. So in this specific scenario, we had warrants existing, half warrant for each of our last two financings that were priced at 18 cents. The stock had moved down to be 8 cents and 8.5 cents when we did the financing. We were approached by several of our large shareholders that asked us, was there appetite to reprice these warrants to align them with the current one? And I can understand it from both sides. I can understand it from a retail investor that doesn't hold warrants, that this functions as an overhang. And I can also see it from the investor standpoint, which says, look, I've wrote you 5 checks through each of your last 5 financings. Most of my warrants have either expired or out of the money. This is a small ticket to finance. And if you're raising at 8.5 cents now, why would you be averse to raising at 13.5 cents via a warrant, which is the delta between 18 cents and 13.5 cents, which is what we did. Very important to keep your large supporters supportive and backing the company in this market. So if you have a basket of large shareholders that have been very supportive over the long term, in my view, it's in the best interest of the company to keep them being supportive and participating and engaged in it. And if it means an incremental reprice of a warrant from 18 cents to 13 cents, so be it. There was already overhang at 13 cents. I personally didn't view it as that big of a deal. There's already warrants at 13 cents. We took some from 18 cents to 13 cents. I don't think it's that big a deal. I know some retail shareholders or non-warrant holders will feel it's a really big deal. They didn't like it. I see both sides to it.
Well, I've never been in your seat. I've only been in my own seat, which is a retail investor, and I don't like it when that happens on my end. Now that you're explaining it, though, it kind of sounds like picking the lesser evil, as in, if you don't reprice the warrants, your big shareholders might be mad at you because, well, should they be mad or not? That's a risk they took. The warrants are not in the money. It's the risk they took, but they will be. So the reality of it is, if you don't do it, they'll be mad at you. Maybe they're not going to finance you any further, which as a retail shareholder might hurt me more. You might have to go and find other people. They might be selling liquidity and so on and so forth. So it kind of sounds like choosing the lesser evil of the two.
Absolutely. You are right on that. It is lesser of two evils. If I had my choice, would I have loved not to do it? Absolutely. But given where we were, given the market, given the support of large shareholders, I thought it was, and we as management felt it was in the best interest of everybody. And I think you're absolutely right that, even looking at it from a retail investor landscape, the absence of somebody writing a $500,000 check into your $2.5 million financing has quite a negative impact on the overall corporate path and ability to continue exploration.
Kind of makes me think how leveled the playing field is overall, but I suppose that's a larger topic for a different time. Permitting, Brian, how's that for you? First Nations, they're active in Ontario. I know most of them are friendly. What's the situation with you?
Yeah, 3 MOUs, as we call them, or exploration agreements, which cover Penn and Dore. We're working yet on Gold Arm, Greater Gold Arm, and this is the community relations, Indigenous relationship agreement side of things. Supportive. Timmins is a mining landscape, and the benchmark and the path has been walked and sown, and there's mutual understanding of what the expectations are. 2% of an exploration agreement needs to go to your Indigenous First Nation partners and territorial holders in the area. When it comes to a production landscape, the bar is moving up. We're not there yet, so we'll leave that expectation down the line. I would say we have good supportive relationships, and from the First Nation side, permitting piece, in my mind, from the corporate landscape, can always be expedited and can always be simplified, but that's just with my vision. And when I put myself on the First Nation side, and you have maybe a group that has limited technical capacity, and you're having to review 30 different exploration proposals and come up with how these impact your traditional territories, that's not an easy task, and you need time to do it. So the fine balance that you have of properly executing in a permitted drill program versus ensuring both sides of the equation are adequately represented, can review their data, is not easy to walk. I'm happy with where we work. I think Timmins is a great place to work. I think the provincial government is doing their best to propagate and support exploration investment in the landscape. So I don't think we have any big hurdles that I would say on this side, and I feel like our relationships are going reasonably well.
Well, so it sounds like there's nothing really to what slow you down over the next couple of months. Like, you have the money, you have the plan, you have the permits, you can just go and drill and deliver results. When do you think your next results are going to come in? What's the cadence of the results that you're expecting over the next couple of months?
Yeah, I mean, we have drilled 5 holes back in June of this year. Today, we put out the initial half of the first hole, and so we still have kind of 4.5 holes yet to put out. We still have a bunch of assays yet to come back. I'd love to see us come out with another 2 or 3 press releases over the next 6-8 weeks, and finalize those exploration results from each Q2 into the market. Today was a big step of outlining to the market, here's the initial zones we hit, very good hit, but also trying to give clarity on what we feel is up ahead of us. And we were pretty bullish in the wording in the statement, and even some photos. I mean, there's other zones down that first hole that are still pending assay. There's other holes that are pending assay that look very interesting as well too. So I'm optimistic we can keep pretty newsy here coming in through Q3, and that we'll be drilling later this year as well too. And I think that's probably a sort of October through November, December timeframe. I feel good about where we are. The summer's been quiet, both from a news flow and an investor appetite point of view. But I feel like, coming into later in August, you definitely get a lot more people back in the chairs. And I feel like today has been a really good example where our feedback's been great. We got volume in the market, having good conversations. Obviously, there was a market there that was keen to listen at this time.
It is true, yes. It seems like now is the right time to come up with high grade, but I suppose all the time is the right time to come up with high grade. You are saying 6 weeks, 3 news releases. That's what you're hoping for. If my calculus is correct, 2 weeks from now, you're going to have a news release. So the rest of that whole is going to come out in about 2 weeks. Is that what you're expecting?
I'd like to get it out before Beaver Creek. And so Beaver Creek's a month away right now. And so give us 2 or 3 weeks. And would like to get the remainder of that whole, all the essays back from that whole and get it published. I think it's going to be relevant. And I want to make sure we do our best to put relevant news out there in a timely manner. And there's still a subsequent 3 holes post that we don't have any assays on yet. That's the time frame. So yeah.
I think Beaver Creek is 3 weeks away from now, and I have to check. But yeah, something along those lines. Yeah, not 4 anymore. 3 weeks, I think. I think it's on the 11th. Yeah,
I think you're right. The 11th through 15th or what?
Something like that. What's your? This is short-term timing that we were talking about, because I'm kind of assuming that I'm going to get an update from you sometime in the future. But what's kind of the end goal, and what's the timing of that end goal? Like, how do you see this thing culminating? And more importantly, what would you call a success? Like, if we're talking, I don't know, whatever time frame you're going to give me, but let's hope you're not doing this in 10 years anymore. So if we're talking in 10 years and looking back at this and you're like, oh, this was a good run, what would you consider success?
I think any exploration junior success is finding a mineable ore body. And in our case, that is absolutely our success, or our definition of success. When you think of where we are at Aljo or Montclair or Penn, these other properties, we need to do our best to balance our capital to show we're finding something that can see a mill. So wanting ourselves through the next 12 months, I really want to see us answer the question on Aljo at Montclair. I want to see us give us this first pass drill test on Muskego, which I think can move the needle. And I'm optimistic it can. So when you think about the ultimate path of a company, it really is driven by the jurisdiction you work in. And the reason we're working in Timmins is because A, there's lots of gold there. B, we think there's lots more gold to be found, and it's to be found at a relatively shallow level. And C, there's lots of infrastructure and people there. So if you find gold at a reasonable amount of gold at a relatively shallow level, it's probably going to end up in somebody else's mill. And history really dictates that that's likely to occur in this camp. So I think discovery in the areas we're working in logically translates to acquisition. And you can take Probe as a very good example. Grassroots discovery within arguably trucking distance to Timmins, found a multi-million ounce ore body at a reasonable depth, sold it for $500 million to Newmont. Ended up in somebody else's mill. Those were the guys that could pay the most, and it was the ones that it made the most sense for them to acquire, because ultimately they had excess milling capacity that wasn't being utilized. So from GFG's perspective, here we sit. We've got 4 mills around us. Cote is coming to full production here at 36,000 tons a day, which is kind of the elephant in the camp. And that may well change cutoffs regionally in terms of trucking distance to Cote as well. But I think Timmins camp will logically drive consolidation. The Newmont sale process of their Timmins assets, which is ongoing right now, will bring a new party to the camp. Pan American, I don't know that will be in the camp long term either. They may not. So I'm optimistic that as you look at the main controller of Timmins infrastructure, you're going to see a change in that in the next 6 months. That's key. Anybody that buys that asset, Timmins Newmont portfolio, is going to really want to put the best into regional exploration, optimize that infrastructure, and probably ensure they're realizing on any regional opportunities that are out there, like the exploration codes that are exploring the truckable areas around the camp. So I just feel that Timmins, from a corporate strategy point of view, logically drives an M&A process as an endpoint. Are there some ore bodies that you'll develop or we could develop on our own? Yeah, there are, but the reality is that the payback exists for other people to have and be able to make good money, and your shareholders make good money by taking it through somebody else's mill. If you ask me time frame on that, it's not imminent. We have Alamos as a good shareholder. We have strong relationships with every producer that's in the camp, and I would say 30 others. So what I do know is that GFG controls things that are valuable. Land 800 square kilometers in a belt that's very productive. And there's very, very few companies that have tenements of the scale of ours. It's unusual for a junior to amass the amount of land we have in an area like Timmins.
If that M&A that you're alluding to here is not happening at $2,500 gold, though, for you, when is it happening? Like, is it company specific? Do you need $3,000?
It's not price of gold. It's not price of gold. It's development stage of the project. And I think there's lots of drivers, financial drivers for mid-tiers producers to buy explorers and developers right now at this price. But I do think that they're cognizant that they want to see a project that they're confident on its being somewhat technically de-risked to the point that they can understand what they're paying for, they can understand the metallurgy, they can understand the core mineability and dilution components of the asset, and does it fit with their piece of infrastructure? They want to answer those questions. Does it need to be pre-feasibility? No. Great Bear got sold without a resource on it. Snowline just published a resource, fine. It puts the pin in it. It was a big number, so good for them. But I think the relevant stages of technical de-risking are milestones that need to be achieved generally for an acquisition to take place. Are there some explorers that are acquired before discovery? Yep, there are, but it's not the norm.
What would you guess the spot in the Lassonde curve would be for you or for the Timmins region as a whole? Because it is, and I think it is jurisdiction related actually, because it is a much more mature district than you typically see. If this was in West Africa, maybe gets acquired earlier on in the Lassonde curve. Would that be later on for you, PEA, PFS?
No, I think in camps like Timmins, you compress the curve. So you acquire things sooner. Projects can be more de-risked. The geological models are more understood. People's infrastructure is more well understood. The value creation, trucking distance, your mineability and dilution, your milling costs, those are all reasonably well understood in a camp like Timmins. So what happens is it truncates that curve. And generally, if you can show something that has the size and scale to be mineable, you're probably not going to have to go through that bottom portion of the Lassonde curve, which is ultimately the analysis and development stage before you get it back into production. I don't think you're going to see that if you actually have something that's truly economic. You can look at Pan American, you can look at Newmont, you can look at Agnico, and you can look at McEwen, Alamos, IAMGOLD. There's your 6 mills, and all of those arguably would have capacity to displace production. And any of those companies and all those companies are currently looking around the district to say, what are you guys doing? What are you finding? Can we understand it better? That just all points towards a truncated Lassonde curve and acquisition arguably earlier. The other piece that drives that is the competitive landscape, where we're not working in a camp where there's one buyer. We're working in a camp where there's 5 or 6 mills. And that creates tension. It creates an urgency. Every company's going to have to go and answer their own questions, but they also know that if they wait too long, or if they're not at the front of the line of understanding these opportunities, somebody else will be in front of them. And they may well miss a really good opportunity.
And I hope again, that over time I'll keep getting updates from you. So hopefully we speak before that happens, or who knows, maybe it happens before the next time we speak. Um, Brian, I've tried being as annoying as I possibly can. If you want me to be a little bit more annoying, I can always play Simple Man on the guitar for you. But what are some other annoying questions that I'm not asking? What's the most annoying question you've been asked so far?
You know, the warrant one is a constant one that we've gotten since we did that. And I'm glad you asked that, because I'm happy to talk about it transparently from the corporate standpoint. And I really think people need to listen and understand both sides of this equation, and see that the alternative path was not one that was preferred. And so I'm happy you asked me that one. It is a tough question. I know it's contentious. You know, the metallurgy piece is something we always get. We touch base on this at Montclair. We touch base on this at Aljo. I think that's an important one. Call this morning. When will you finance again? You touch base on that. That's an annoying one. I don't mean an annoying one. It's one that needs to be answered, and it's so key. Yeah, you know, I'm trying to think of what annoying other questions we get, or really difficult ones. You know, we really try to do what we said we would do. And I'm disappointed that Rattlesnake took so long to find a home, the right home, because it sat in our portfolio and arguably given us no value for a couple of years. So, you know, I'm happy we got that to a stage where last Friday we could publish a definitive agreement and do what we said we'd do, which for too long it's been kind of like saying that's what we'd like to do, but not getting it done. So I'm happy to get that that piece accomplished. Yeah, you know, I think those are the kind of, I don't know. I don't think we have a bunch of annoying questions outside of those ones. If I think of the sensitivity of the shareholders, look, the 240 million share count. Yep, nobody likes that. Me, least of all, as a shareholder, relevant as well. You know, but I do think you have to go back and still say, look, the win on any relevant discovery is 50 million bucks on a discovery hole, and that gets unlocked whether you're you know, a 200 million share count or a 20 million share count. Obviously, it's going to drive different liquidity and different share price moves in response to that. But I'm super happy with our shareholders, Lundin family, Alamos, bunch of institutional shareholders, really strong US retail guys that own 10% of this company, maybe 15% combined between three of them. So I know that there's some really big chunky shareholders where we can put our hands around 50-60% of our float in a very small list. And that's a good thing. I don't know. I wouldn't have much more else that I would say is difficult questions. And in many ways, I always appreciate these opportunities where we need to be asked the tough questions, and because those are what stakeholders and shareholders want to listen to, not the meatball questions, but you know, the difficult ones. How's somebody going to handle those? Did they come across trustworthy or not?
I wish more people would think that way. That certainly make my time easier out there. But I appreciate you doing this. I've already overstayed my welcome, and I've taken more time than you initially promised me. We've been speaking for about an hour and 10 minutes, actually, or something along those lines. But thank you so much, Brian, for doing this. Let's catch up hopefully soon. And yeah, thank you so much for sitting down with me.
No, I really appreciate your time too, and your audience, and just know that we're always on. Happy to have a call, and just this visibility is fabulous. So thank you.